Good morning, folks. I hope everyone out there is having a good trading week so far. We're going to be getting this edition of Back to the Futures with me, Markets and Mayhem, going here and now. The folks at Bookmap would love for you to join us on the Discord they've got there. They've got a lot of cool stuff going on. And I think it's a great spot to learn more about Bookmap. They have education about how it works, about how different traders use Bookmap for their process. So I think it would be pretty helpful for a number of different reasons. So definitely come by and check it out. You can use the QR code on screen to do that. Or you can visit discord.com/invite/bookmap. A little bit about me. I've been trading for a while now. It's about 20 years. I know that dates me a little bit, but it's been an incredible journey. I've had a lot of fun, and I love sharing my experience with you all. So feel free to pop in the chat, ask any questions you have. You can also request charts if you'd like to look at different symbols. We're going to be doing a bunch of chart requests for anyone that wants to look at stocks. Just make sure they're liquid enough. If it's not a very liquid stock, you're probably not going to see a lot that adds value. So that would be like the main point. So, if it's one of the bigger Mag 7 stocks, or even one of the top 50 stocks in S&P or NASDAQ, that should be big enough. And why do I watch order flow? Why is this an important part of my trading process? Well, the biggest thing that I think is important is looking for the differentials in the order flow. You can see that in the way the Bookmap tracks the volume bubbles in stocks, futures, crypto, but also in the delta volume profile. So you can see that in the way that I have volume profiles set up, where you can see the difference between buyers and sellers, where the aggressors are at different price levels. So the volume bubbles and the volume bars, if you have them set to delta on the bottom, they're showing you that difference in between buyers and sellers as a matter of time. And then the session volume profile is showing you that difference between buyers and sellers as a matter of price. Right? So both of those can be pretty valuable. The other thing that's important is looking for large passive order flow. And Bookmap allows you to do that when you're looking at futures using Rhythmic or Bookmap data. You can see the icebergs that may act as turning points if they're large enough in flow. So those can be pretty interesting to be able to observe, especially if you see other confluent events happening around the same time. Especially things like exhaustive trading action and then an iceberg-driven reversal. So you might see a huge stop-out event. Let's say market goes down really big on a Trump headline, right? You see a bunch of stops get run, but then you start to see these larger icebergs coming in, buying and buying and buying. That can mark a reversal point, and that's one of those areas where order flow can help to define where those probabilities are. So why do I use Bookmap to watch order flow? Biggest reason is that it brings a lot of this together on a single screen, which makes my job a lot easier. I do have a lot of screens in front of me, but believe it or not, I don't want to dedicate them all to charts. I want to have discrete charting for specific instruments and time frames, and I might tie that up to 1 or 2, maybe 3 screens. The rest of it is about research, it's about execution, it's about being able to monitor other components of the market. So for me, Bookmap brings a lot together on a single screen. It also has that tabbed interface so I can go between instruments and different views of even the same instruments. If I want to set up filtered views, for example, pretty effortlessly. Now we do have some pretty cool exclusive deals for you all. Been chopping at the bit to get access to Bookmap, or if you just want to see if you want it after this stream, after you've learned a little bit more about how it works, you can visit traderaid.com/bookmap. That's traderaid.com/bookmap to learn more and get up to 40% off using the special offers at the bottom of that same page. So again, visit TraderAid.com/bookmap. You can learn more about what their offerings are and get 40% off scrolling to the bottom of the page under the special offers. And if you want to check out TraderAid, we have a pretty good discount going on right now, actually. You can use, it's not on the screen, I forgot to add it to the slide deck today, but you can use the code year3 for 33% off. That's year3 for 33% off. So those are all the deals. We're going to dive right into Bookmap now. So today we're going to focus a little bit more on some of the major stocks that are out there to give a better sense as to what's moving the market. It often does come down to some of these bigger stocks. And again, I also welcome you all to request charts in the chat. If there's something you want to see, let me know. Good morning, Leroy. How's it going out there? ASML has been requested, so I'm going to add that up here in just a moment. That is an interesting one. That's one of our trades, one of our long trades at TraderAid, so cool mentioning that one. I'm just interacting with some folks on Twitter. We also have requests for Apple and Tesla. So let me pop ASML on while we're waiting for the market to open here in just about under 12 minutes. And I'll be doing a little bit more in-depth analysis on these once the market is open and we've got a little bit more data to work with. But we'll go through some of these pre-market, starting with Apple, and I've added ASML to the rotation, so we're going to get to that one in just a moment as well. Good morning, folks. Thanks for tuning in. Got some more folks saying good morning in the Twitter chat. And feel free to speak up. Remember, this is a session just as much for everyone else out there. So y'all are always welcome to ask questions, request different symbols to look at, ask more about how Bookmap works, how I trade with it, really anything you'd like. Let's have some fun this morning. It's Taco Tuesday. We got Jay Powell coming up soon at 10 a.m. That should be fun as well. So let's take a look at Apple. Let's pull it back just a little bit. You can see the overnight session, pretty sleepy, but getting a nice pop right now on AAPL pre-market. And we could see the stock's up about 1% pre-market here. Amazon, a little bit of the opposite look, getting just a little bit more selling pressure pre-market versus Apple, which has bid up over 1%. Amazon's down about 1%. And you can see there's just a little bit of interest here growing below that current bid. So that might act just a little bit magnetic. Of course, we'll see how that liquidity changes as the market opens. You're going to see these books become a little bit more hot, meaning there's going to be a little bit more liquidity added in after the market bell on a lot of these stocks. Then we have ASML. ASML looks a little bit choppy here. Let's see what the it's up just about 0.4% pre-market. And just a little bit of a thinner order book. If you compare ASML, because it's it's like a, I believe it's an ADR here. It is a Netherlands company, so it doesn't have quite as big of an order book. You can see that here. It's just got about 53,000 on depth versus something like Amazon, which has, you know, around 500,000 on depth. So it is an order of magnitude in difference in terms of just how much participation there is. We'll see how that changes after the opening bell. Taco's favorite dance is the salsa. Awesome. All right. Google looking a little soft this morning. Down 1%, a lot like its peer Amazon. And it looks like that selling pressure just kind of been building since the pre-market session started. A little bit more pressure in the last, let's say, 10 minutes or so on Google, or Alphabet, as they prefer to be called, but no one wants to call them that. No one knows them by that name. Let's move on to Meta. Meta really defying gravity. It's been impressive how much this thing has run. Last week, its pattern looked a little bit more like you know, a rising wedge that could break down, or at least a channel that was towards the top of that channel. But we can see, and I'll just bring this on screen really quick, just a quick and dirty chart from FinViz. You could see that pop above that channel, and it's just been building on that after earnings. So that is a pretty bullish look. I do still think it's a bit extended here, but obviously markets are going to market. So Meta this morning down just about 0.5% ahead of the market, making some new lows just in the last 10 minutes or so. And Microsoft down about 0.5% pre-market here as well. So just a little bit of a feel of pressure in tech outside of Apple, which sometimes Apple ends up being the safe haven inside of tech for one reason or another. And it seems I got a bit of that feel this morning, where Apple's up and a lot of these other guys are bid down. I'll look for some catalysts in just a moment. I'm pulling up my Benzinga feed. Netflix, which isn't really part of the Mag 7, but it's still worth watching. But here's something interesting. Look at the book depth on Netflix. It reminds you of ASML a bit because it's similarly light. And again, we'll see how that may change after the market opens. Leroy, I'm not sure if you're asking, are you talking about showing the chat in the stream? Let me know what you're asking, buddy. I'm just trying to make sure I do a good job for the viewers out there and give them what they want. So, you know, if that's what you want, I can look at that in the future, having the chat somewhere here as well. There's like 3 or 4 different chats I'd have to find a way to aggregate in order to do that, but it could be cool to do. Moving on to NVIDIA, everyone's favorite stock to love, to hate, to write conspiracy theories about. It's amazing how much energy there is on this stock on both sides of the ledger. I kind of come in a little bit more neutral. I think that NVIDIA has some serious risks ahead of it. I don't think it's a giant scam. I don't think it's the next Enron. I don't think any of that stuff has any merit. But I do think that we're seeing significant optimization of the software stack that powers AI. That could reduce demand a bit as time goes on. We're also seeing specialized chips for some of the most intensive computational operations we do for AI, like training, and Amazon making custom silicon like Trainium. It's another risk. And then we see more countries talking about cracking down on NVIDIA's monopoly, and they have 95% of market share in data centers. So I'm more neutral, aware of the risks on NVIDIA, thinking that there's been some plateauing in the technology, which I think is important to realize with quantum tunneling and with Blackwell being more incremental than revolutionary in terms of the gains it's providing. So just some things to think about. Again, neutral view, not really strongly bullish or bearish of NVIDIA, just aware that some of those left tails are fattening. But today's session on NVIDIA looks like there is a little bit of selling pressure ahead of the market. And NVIDIA, like its peers, like Microsoft and Amazon and others, it's down just about 1%. They're all kind of having a down 1% party this morning. So let's just really quickly look at the implied cash open for the NASDAQ. And NASDAQ 100 implied open down about 0.6%. Oh, okay, Leroy, that's a very, I like that. So what Leroy says is, he was asking if he could look at the chart of each of these stocks before zooming into Bookmap. And you know what? That actually makes a ton of sense. So let me see what I can do about that. Bear with me just a moment here. Let me see if I can bring that up in TrendSpider. So just bear with me here. We got a little bit of time before the market opens anyway. While I'm doing this, if y'all have any other symbols you want me to add to the rotation of things we're going to be checking in this morning, let me know. All right, so I've got that set up. So what we'll do here is we'll start on Palantir, and then on the next run, we'll use the big charts, and then we'll zoom in for everything. So what I'm going to do is I'm going to set this up as like a full screen app, and we can just pivot between them. So here's Palantir. My God. Look at this chart. This is just insane. I am long this stock. I have been with a cost basis of about $7, so it has been a sizable winner, shall we say. So seeing this chart's kind of interesting, putting things in perspective. I do think it's run a bit ahead of itself, and it would be healthy for it to consolidate, cool down, maybe grow to that valuation. You got a lot of gaps in this chart. Gap theory would suggest that at some point some of these gaps get filled, right? So we'll see. We'll be watching very closely. And we have this one in the Bookmap rotation today as well. So that's Palantir. Let's pull it up in Bookmap. And yeah, Leroy, thanks for that idea. I think that's a really cool idea. So I'm gonna be doing that moving forward for these stocks and some of these other charts in Bookmap. So Palantir this morning trading 115.72. So pre-market, just 10 minutes ahead of the open, down about 0.75% on Palantir. Yesterday it closed up 5.23%. This thing just doesn't stop. And it's interesting because I know there's a lot of folks saying, oh, well, there's this enormous, euphoria around this stock. And, look, with the chart and what it showed us just now, it's hard to disagree with that at the surface level, right? But here's what kind of is interesting about it to me. And I'm just quickly pulling up this market chameleon chart. Okay, this is showing the skew between puts and calls. What it shows you right now is it's actually slightly bearish. It's pretty much normalized, slightly bearish skew. So what that suggests is there isn't this enormous amount of speculative fervor coming in via options into Palantir, right? So yeah, retail are buying Palantir, other people are buying Palantir. In fact, a lot of institutions are buying Palantir. That's something that doesn't get talked about really as much as it probably should. But we're not seeing those traditional signs of a stock that's seeing euphoria in the options for it. So that's one reason I think that it hasn't had this sort of like alarming, dramatic pullback, whatever you want to call it, because we have seen continuing signs of encouraging growth. And while, yes, the valuation is arguably stretched, it still looks modest in comparison to a lot of these quantum companies that don't make any money and may never make any money. So we're kind of, balancing what we see in the options positioning, which is, again, arguably not too extended, with the chart itself, which was, this is a stock that was trading like in the fives in 2022. So it's been an incredible run for Palantir. But, I would love to see it settle a bit. There's just no signs of it being too overbought in data-driven metrics, not things like RSI, which, let's be completely honest, if we want to have a real frank discussion about technical analysis, I'm going to say something that is going to frustrate some people, but eventually you'll find it's true. If you're in an uptrend and you hit the upper Bollinger Band, it doesn't mean anything. It's not implicit resistance. Now, I know that some folks are going to find that to be a bit annoying, but the reality is that the upper Bollinger Band matters more in a downtrend for an overbought or a, sell into level. Just like RSI being above 70 during an uptrend doesn't give you a sense of overbought. It's not what you think it is. That matters a lot more in a downtrend. If you get a pop above even 50 or 60, that can be sellable on RSI. But these things that we've conventionally been led to believe, like, oh, the upper Bollinger Band resistance, the lower Bollinger Band support, that only matters in a consolidation, really. Like if you're going sideways and you have this sort of predictable chop pattern, yeah, Bollingers are great for that. But once you see that band, that Bollinger Band expand, so you go from a squeeze period to a breakout where price volatility is becoming bigger and bigger, then the top band, if you're going up, is more of a compass than it is a resistance level. So just something to think about. I know we trade in all different ways, but these indicators can be really helpful with some nuance and getting away from maybe some of the more conventional thinking. Anyway, that was quite a departure from the core subject matter. Let's get back into it here. And let me pull up Tesla. So Tesla coming back to earth. And this is a company where I still think there's a fair amount of risk here. I don't see any reason why we can't get back to the high 200s, like 275, 280, even maybe filling this gap lower. But at the very least, kind of getting to this top area wouldn't be too surprising. That's closer to like 260. And the reason is that this is a company that's actually in quite serious trouble if you look at their fundamentals. So Tesla has not had a particularly good time with their earnings. The last earnings report they gave, we showed slowing year-over-year sales, reduction in earnings from vehicle sales. Of course, if your sales are slowing, you're probably not going to be doing too good on earnings. But what made the earnings look a lot better than they really were the sale of carbon credits and appreciation on Bitcoin holdings. Not really what you want to be focusing on too much if you're saying we're a growing auto AI robotics company. And there's a lot of fluffy nonsense that management said on the call, which really doesn't reconcile with reality. So I feel like this is a company that's actually seeing a decline. It's not a growth company anymore. They're not growing anymore. They're actually shrinking, and their core product business is cars. They haven't really been able to monetize self-driving or AI or robotics in any meaningful way. And so I would look at this one as, even though it's come down quite a bit and people are probably chomping at the bit saying, boy, I would love to buy some of this. Be careful out there, folks. I don't know that this is over. I do think there's still risk. I know Tesla tends to trade inverse to its fundamentals, but I do still think there's some risk with this one. So let's go into Bookmap, take a look at Tesla this morning. And Palantir, by the way, big level at 117, about 39,000 shares on offer there, and big level at 114, about 39,000 shares on bid. Tesla this morning continuing its downward trend, down 1.19%. And we see sellers dragging that point of control a bit lower as well. So overall, a lot of the tech looking pretty soft this morning outside of Apple. Let's go back to Apple here, but let's bring up the bigger chart. We've got just about 4 minutes before market open here. So Apple's chart, yeah, it's not looking too promising overall, right? You've got this big move up. A lot of that was happening while other parts of the market were under a bit more pressure. Apple kind of has been this sort of inverse. It's almost been like trading as if it was a safe haven, but nevertheless, you had a drawdown back to those lows from early November, a bit of a pop, and now we're just selling that back down overall. So yeah, Apple is set to open a bit higher, but the technicals on this stock look pretty poor. And if we go out to a weekly view, it does look like a chart that's sort of consolidating here. If we start to break the bottom of that consolidation range, I think we get back to the high 100s. You've got this whole very well-defined top area that could act as support, say between 195 to 190. So basically, if we're not able to hold 220, this thing could break down pretty nicely on Apple. And Sam in the chat, she's saying that Baba is partnering with Apple for AI. Baba up about 2.84% today. And I will say one thing about Baba that I've been really impressed with is their Quen model. So if we're talking about large language models, chatbots, you know, all the rage right now, these transformer models have a lot of different competitors. And one of the ones that I felt was actually the most capable, well before DeepSeek, was Quen, Qwen. And Quen is made by Alibaba. So I'm not too surprised to see Apple looking at that and saying, you know what, this could do a few things for us. One, we're seeing tension with China, which is one of our important markets. It's also an important area for Apple to produce their products. Maybe in Tim Cook's mind as he's cooking, right? Trying to figure out how to save Apple from all these forces that are kind of undermining their dominance. One thing that they can do is partner with Alibaba and maybe appease Xi a little bit in China. Maybe ease those tensions because China was looking at cracking down on Apple pretty directly. So this could be a bargain that's been struck. But the other part of it is it makes sense. These AI models from Alibaba are actually quite good. And they are open source. So if Apple does any sort of on-device stuff with these mini models or they host them in the Apple cloud, that alleviates some of the concern that data is going over to China. So zooming back in on Apple stock this morning, seeing a bit of a round trip there. So we had that catalyst from Alibaba, which is still helping Alibaba shares. They're up almost 3%, but Apple shares now up just 1/3% here. Opening bell in just about 30 seconds here. And folks, remember the highlight of today, the big event. It's got everyone's attention that everyone's going to be watching and probably have a big tub of popcorn for will be Fed Chair Powell's testimony at 10 a.m. Eastern. I know we're all eagerly anticipating it. It's the event of our lifetimes. And, you know, that's in front of the Senate today and tomorrow in front of the House. You get the best of both worlds. It's going to be amazing. I'm sure you can tell there's maximum sarcasm coming through, but if not, wanted to say so anyway. So Apple now opening up, market opening up here, seeing just a little bit of pressure off the open. NASDAQ down just about 0.7% here. S&P futures down about 1/3%. You're now seeing just a little bit of a pop in Apple. We're going to go around and look at some of these other stocks, but if y'all have any chart requests, any stocks that you'd like to look at, let me know. ETFs as well. I'm going to do more of a stock and ETF theme day today. I know I focus a lot on futures, but I figured we'd mix it up today. I know a lot of folks out there also love to look at stocks and ETFs as well, don't necessarily trade futures, and that's fine. Fannie Mae from Rando. All right, that's an exciting one. So first, let's pull that up in TrendSpider. Oh boy, Phil Ackman's pretty happy with this, I'm sure. This is one of his picks for that Robinhood stock picking charity, which has nothing to do with Vlad Tenev's company and something that I think pre-existed before it even was around. Nevertheless, Fannie Mae looks a lot. It looks like a lot like that Palantir chart. It's this sort of straight up rocket ship. A lot of this has to do with the idea that maybe this will be allowed to spin off, privatized by this administration. So that's helping to catalyze some of this movement. This has been easily a 6 to 7 bagger depending on where you were getting in, but definitely a huge move here in FNMA. And you know, we can see we're in a part of the volume profile where there hasn't been a lot of transacting. So this move really from $3 to $7 and in excess of that is on kind of poor structure. So, you know, if you don't have a continuation of buying, continuation of catalyst, this can retrace pretty quickly. There's a lack of transacting that's happened here. So you can expect a little bit more volatility overall. So let's zoom in and pull this up into DX feed. Ooh, we're not getting a symbol on that. That's interesting. Hold on. I think it's because of where it's listed that it's not coming up. Yeah, it's OTC. So I'm not able to pull up the data for that one. We've got a request for Broadcom. So we're going to pop onto Broadcom. Just got... give me one moment. I've just got to check on something real quick. Just give me one moment. I'm just taking care of something in the background here, folks. All right, so let's take a look at ASML. I'm sorry, we're looking at Broadcom. A lot of stocks that are popular that are semiconductor proximal that start with the letter A. All right. So this one's had a pretty powerful move. I do think that there's a little bit of an overreaction to the DeepSeek news on this stock in particular. It wasn't really impacted the same way an NVIDIA would be. So I do think that there is, reason to buy that dip. We did see that dip kind of aggressively bought and pushed into, so we'll just zoom this in a little bit. You can see that gap down. We never quite filled that gap lower. Now, I won't say that I'm a religious subscriber to gap theory. I just think that it does have some validity. Often gaps are filled, but not always gaps are filled. So that's something to kind of keep in the back of our mind, that, that gap could come back. It could be filled later. But overall, I think the bigger risk to a lot of this is just the presumption of really aggressive spend on data center expansion. I know that the mega caps have come out, sort of reinforced that, but I would still say that this is going to probably end up being a race that's just as much about scale of how much hardware you have in the AI space, how much capacity and compute you have, as also efficiency. How efficient are you using that hardware? Are you delivering the sort of results that you suspect you should be able to deliver with that scale of hardware? Are you able to gain orders of magnitude more efficiency with things like what DeepSeek was able to reveal, right? Which was that if you changed how you train and how you do inference, if you take some clever tricks, and I can be more specific. If you're using 32-bit precision on training, you're using a lot more resources than if you're using 8-bit precision. And if you can get similar results from 8-bit that you can from 32-bit, which is one of the things DeepSeek did, then you can certainly gain some more value going to 8-bit because you're using orders of magnitude less compute. So long story short, I do think that the demand for some of these semiconductors could still come down from here, simply because I think the aggregates, the assumptions about where we're going to go with all of this data center expansion this year has probably run a little bit ahead of reality. That's just my thought. So this stock chart to me overall looks like it's really trying to consolidate, trying to get back up into this area of the volume profile. You can see there's a lot of willingness and eagerness to transact up here. It's different than Fannie Mae. Fannie Mae didn't really build a lot of acceptance and transacting at its highs. Avgo did. So that's good as long as we don't start to slip too much lower. You can see that it gets a lot more volatile. This 190 area, where you can see no one's wanted to transact here in the last, say what, 4 months? That's a pretty key area. If we do get back down there, you want to see a big bid back up to the 230s. Otherwise, you really do risk getting kind of magnetically pulled back into this other area of volume profile where there's been, again, a lot of transacting, right? You can see where people want to transact and you can see where they don't. So that makes that 190 area a bit of a decision zone. So that's one of the things that I would look at. I don't love the fact that this is kind of a lower highs, lower lows type of chart. Like here's the highest high. Then, you make a lower high, a lower low, presumably a lower high here. If that ends up being the case and we start to pull lower, momentum does favor a test of that 190 area. So for now, cautious on Broadcom. If you were lucky enough to buy that DeepSeek dip, then I think it's a decent area to take some profits off. But I would be watching momentum here because it looks like it's stalling out. The last several trading days, we really can't get above this really large area of supply. So there's still folks that are trapped up here. That's the other thing to think about. With all this excitement that you can see in these highs in the chart, all these wicks, there's still folks that were buying up there thinking, oh, this is where I'm going to start my investment in Broadcom. And obviously starting your investment in Broadcom at like 235 you're going to get a little nervous when you have these kinds of runs lower. So they become supply. They become more motivated sellers the further away from their cost basis price goes. So that's Broadcom on the big view. Now let's zoom in to the intraday view. I'm just going to pull it over here to sort of keep things somewhat alphabetized. And we'll give it just a moment to pull. We're going to backfill, say, 3 hours of data on this. All right, we have a request for S&P 500. We'll look at that in just a moment. I'm going to give this chart just a moment to also, let's see, did it do? Yep, it's done its backfill. So we've got Broadcom overnight, bit of selling pressure, you know, into the pre-market. And then we can see there's a pretty aggressive bid coming in. A lot of absorption from both buyers and sellers. We can see that on the chart as well. But overall, that dip right off the open being aggressively bought. So there are still willing and able dip buyers in this stock, and there's a lot of interest in higher prices today. You can see there's a delta of 392,000 where offers are in excess of bids. So on the one hand, you could consider that supply, but on the other hand, you could say, but that also does tell you there is interest in higher prices from here. Not terribly higher, right? But really looking all the way up to like the 240s. So we're going to pull up S&P futures here. Give me a moment. We're going to pull that up on DX feed. We'll backfill about 6 hours of data. And keep the requests coming, folks. If there's anything you'd like to look at. All right, let's go over to that S&P futures chart here. I'm just going to clean this up, so give me a moment. All right, so we have the S&P chart on screen here, but as promised, I am going to dive in first via TrendSpider, and then we're going to zoom in using Bookmap here. So we're going to look at SPX on TrendSpider just because it tends to be a little bit more complete the way they fill their data. If they let me. Nope, I don't have that set up quite yet. So we'll look at SPY for now. So the big takeaway, and you could show this with any of these charts, you could show it with SPY, S&P futures, S&P cash. The big takeaway is we're sort of consolidating. Momentum continues to favor the buyers, but it is waning. I don't love the pattern here. It does kind of look like lower highs and lower lows, especially if we make yet another subsequent lower low. Then it's going to be one of those sort of fool me thrice scenarios for the buyers that are continuing to try to fight this. But at the very same time, I don't see a lot of reason to be overtly negative of the market where we are. We're seeing a bit of a rotation. We're seeing a rotation out of some of the mega caps and into a broader subset of S&P stocks and NASDAQ stocks. So if you look at QQQE, if you look at RSP, these are ETFs that are equal weight rather than being market cap weight. And we're starting to see them come back to life a bit. So I do think that's something to keep an eye on. Do we continue to see earnings improving for the inglorious 493, the less loved parts of the S&P 500? And if we do, and we continue to see that rotation away from mega caps and into some of these other stocks, then RSP ends up being a pretty decent way to gain long exposure to the S&P, just like QQQE ends up being a pretty good way to gain long exposure to the NASDAQ, because you're getting equal exposure to every component rather than weighting them by their market cap. So overall, S&P chart looks a little bit challenged here, but we're not in a territory where I could say the bears have an upper hand. We're more in a consolidation, still overall in an uptrend. We can see S&P is still above the major moving averages, still above the 20-day, it's still above the 50-day. Of course, it's above the 100 and 200, but it's just sort of consolidating and waning in terms of momentum. So that's the backdrop we have going into this view of S&P this morning. Overnight, pretty much a flat tape, but we are starting to see buyers coming back in just a little bit more aggressively now. So let's just pull this up from the market open, and you can see right off the open some pretty chunky buying flows into the S&P, now just starting to level out a bit. So let me just take a look. I just want to take a look at one area real quick. Yeah, so we're not too far from the gamma flip level on S&P. The delta, the implied delta right now is about 22 handles between SPX and S&P futures, and the gamma flip on SPX is 60.54. So that would put it on ES to about 60.76. And wouldn't you know it, here's this huge glob of liquidity overhead that's just at that gamma flip level. So I think if we're going to look at an intraday pivot for S&P futures, I would just stick with 60.76. We can see the market thinks it's important too. There's 1,000 contracts sitting overhead there. That's the largest on the book. Part of it is the algo that follows price, but most of this is just the market giving you a sense that options really do weigh heavily on price discovery for the S&P 500. It's let's see. I think the S&P 500 futures contract trades about 300 billion, 350 billion a day. The SPX options trade about 1.2 trillion in notional every day. It's both notional figures. So the S&P options are about 3 times bigger than the futures flow. So it really is the tail that wags the dog. Doesn't mean that using conventional order flow analysis on futures is invalidated by that. It just means you got to know where the flow is starting. And one area you can gain an edge as a trader is watching the options flow. It's one of the reasons I've built a lot of tools around that. John Gross asks, can we take a look at SLV? Yeah, I'd be happy to look at SLV. That's an area that I am watching with a lot of interest right now. And so we've got SLV here on the Trend Spider chart. And you can see that we're going to zoom out a little bit on this one. So you can see, you know, on the one hand, if you're bearish of this, you could say, oh, look, it's making a head and shoulders. And if this right shoulder comes down, breaks the neckline, you know, we're coming back to the 20s. Valid argument. Okay, that is a valid argument, but it doesn't mean that's the only argument. On a monthly chart, especially when you really zoom out on silver, this looks really bullish. Like, it looks like we put in a multi-decade type of bottom here and are just grinding higher and likely to eventually go back to some of these highs we saw in 2011. I don't know if that all happens this year. I think that has a lot to do with China. China uses about 15% of global silver, so they're a pretty key market. And if they do stimulate in size, I believe that's going to really let out the animal spirits in the silver market. So I love the way the silver chart looks, because to me, this is like a really big rounded bottom. And typically you have much larger moves off those kind of saucer or really big rounded bottoms like we see in silver. So silver to me looks really strong. I just want to continue to see that grind higher. I don't want to see a parabolic move. What you see when you have a move like this, which it's nice to be long during it, but it ends very quickly and unceremoniously and often violently. And so, it's much healthier to see this sort of grind. These are monthly candles. So you imagine with silver, month after month after month after month, seldom interrupted. You had this huge move in 2011 that ended up about $48 an ounce. When you see that kind of parabolic move, you've got to get out of the way as soon as momentum shifts, because it's not going to be generous. Like you could see, as soon as you topped on silver, that next month candle brought you down to the 30s again. And you had that weak attempt to get back up. There was still a lot of excitement, still a lot of dip buying, and it just got sold into a new lower low. That's that big picture trend shift. Well, we have that going the other way now, in a much more gradual and methodical kind of accumulation. Now, what's interesting about that is those sort of gradual and methodical accumulations often precede much larger moves. So the key point here being, eventually silver probably does go parabolic. When it does, that's when it's time to be a little bit more cautious about those longs, managing that risk, and especially initiating long positioning. Now let's pull up SLV inside Bookmap here. And we're just going to do a 3-hour backfill. Can we also look at gold? Yeah, absolutely. So James asks, what tools would you recommend to watch options flow? So I'm going to just take a moment to talk my book a little bit. I do have tools that I built for our Discord to watch options flow and positioning, as well as a tool called the SPX Options Visualizer for Bookmap and Motive Wave. So if you're already on Bookmap, you can check out traderaid.com/SPX. And that's where you'll be able to learn more about the SPX Options Visualizer. You can also learn more about our Discord on that website. But suffice it to say, 2025, I'm going to be building out a lot more tools for options flow, for positioning, for inferring what kind of movements we can have. But we already have some really cool ones that let you see the interest levels in just about every optionable security out there, whether it's a stock, an ETF, an index, etc., already on the TraderAid Discord. So if you're interested, you can check it out. You can get a 33% discount on your first term of your plan using the code YEAR3 at checkout. So we got SLV on screen, pretty flat today overall, down about 1%, but you can see just the tape here, pretty flat over the last 20 minutes. Let's zoom out just a little bit. Yeah, pretty flat overall on SLV here. So not a lot to see on this one, but I will go back to the other chart here for just a moment, just to show, again, this huge rounded bottom. To me, this is exactly what you want to see if you're looking for one of those sort of multi-year breakout reversals. And if China comes online with a much more significant amount of stimulus, which I suspect to be the case in their March meeting, and Aisha, my partner and co-founder at Macrovisor, wrote a great article about this. You can go to macrovisor.substack.com, read about it in the weekend edition. So if you want to learn more about what we're thinking for silver this year, check that out. Let's go over to gold. And just what an incredible chart on GLD. And we are looking at a monthly chart. So you remember what I was talking about with that silver chart when you kind of start to go parabolic, to be a little cautious? If you folks have followed me for a little while, you'll know that I talked about $2,600, $2,700 gold happening in September of last year, months and months and months before it happened. I felt very strongly that we would get to those levels. And then as we started to approach them, I said $3,000 gold, the first half of 2025, no brainer. I think we're going to get to 3,000 quite soon. But from there, I'm taking off 2/3 of my longs because I just see too much giddiness. And I've been around the gold market, you know, since about 2007, I've been trading it. I'm not a big fan of parabolic moves in anything, especially commodities, because they tend to revert, and they tend to revert violently. Last night, Peter Schiff was having a Spaces talking about how $3,000 gold's like the most important price point that's ever happened. I've seen more commercials for buy your gold, you know, sell gold, all that sort of stuff coming back, more of the gold newsletters, more of the gold doomsayers, the dollar's dead, all that sort of stuff. You know, all that kind of stuff going on. So that gets me a little bit concerned. I don't like seeing that. Because the last time I've seen that sort of stuff, it led to a pretty nasty decline in gold. I feel like sentiment is really extended, flows are really extended, positioning is really extended. That's also a sign. So I like gold to 3,000. I don't really like it much after that unless we correct or consolidate. That doesn't mean it can't go higher. It certainly can. I'm not saying that's it. I'm saying for my own purposes, and given how much I've made on this trade and where risk is starting to become bigger and more pronounced than reward, my systematic approach says, let's start taking some off. So I'm going to take 2/3 or my core position off at 3,000. I'm going to keep the runners on. And I also have gold producers. I have juniors and seniors. One of the ones I like a lot in gold is Rio 2. It's on the Toronto as Rio.B, or on the OTCs as Rio FF. It's run by Alex Black. And I think that's a multi-bagger in the gold space. I actually think that's probably one of the best setup juniors. But be careful out there. Do your own due diligence. So, folks, if you're interested in Bookmap, definitely check out TraderAid.com/bookmap. I'm going to put that in the chat as well, just so you all know. And if you're interested in Trader Aid, we've got a 33% discount going on until Feb 15th for the first 33 that sign up. So there's limited amount left. Use the code YEAR3 at checkout. And that applies to plans. It also applies to one-on-one coaching sessions. So folks on the Bookmap Discord and YouTube, I want to thank you all for tuning in. We're going to switch over. So I'm going to end the stream on Bookmap, but we're going to switch over to Powell's testimony. So on Twitter and on my YouTube, you can stay tuned. We're going to watch Powell's testimony that's coming up in front of the Senate. I think it'll be kind of interesting to watch. I'm not going to say it's going to be fun, but I think it's going to be interesting. So as always, I want to thank everyone for tuning in to this episode of Back to the Futures with me, Markets and Mayhem, every Tuesday at 9 a.m. Eastern. Be sure to tune in. Join us on the Bookmap Discord. Check out what all they have to offer there as well. And stay tuned on my Twitter feed and my YouTube. We're going to be streaming Powell's testimony and Q&A in front of the U.S. Senate. And we're still waiting for that testimony to start. So I'll have that going live as soon as it comes on. But let me just shift up the labeling here. All right, we are going live on the testimony.
The Fed has been susceptible to political pressure. Take, for example, the Fed's involvement in the Network for Greening the Financial System, a group dedicated to green financing and climate change, which the Fed joined in December 2020 as President Biden was about to assume office. Just last month, the Fed announced that it had pulled out of the organization as President Trump was getting ready to be sworn in. To the American people, this is flip-flopping in the political wind. Too much focus on climate change instead of supervision is consequential. And in March, just 2 years ago, we saw the failure of Silicon Valley Bank. SVB marked the third largest bank failure in U.S. history and the largest since the 2008 financial crisis. And yet not a single federal regulator was held to account. In fact, the FDIC filed a lawsuit against bank executives which accused the SVB of egregious mismanagement. And I agree. How is it that no bank supervisor has faced any consequences? With 30 MRAs and MRIAs that never had timely action at SVB, how can the people who are supposed to be our cops on the beat have not faced any recourse for such egregious failures? I simply don't understand. We must all address the fact that over the last 4 years, the Biden administration and Bidenomics have devastated, decimated, and destroyed hardworking families' ability to support themselves. During Joe Biden's time in office, overall prices rose by over 20%. Energy prices, 34%. Transportation costs, 31%. Groceries, 22%. But that's not all. Thanks to Bidenomics, 2/3 of Americans have less than $1,000 in their savings accounts. But there is good news. Things are going to get better. During his first term, President Trump kept his promises to the American people. In the first 3 years of his presidency, President Trump built the most inclusive economy ever. 7 million jobs created, and 2/3 went to women, African Americans, and Hispanics. It's time to once again make America's economy work for the folks working paycheck to paycheck. Joe Biden broke our economy, and Donald Trump will fix it. For too long, bank regulators have followed a black box regulatory framework with little to no recourse. The FDIC, under President Trump's leadership, recently released never-before-seen supervisory documents which confirmed that Biden's Operation Choke Point 2.0 was real, despite assurances that these unacceptable practices would end following the Democrats' first Operation Choke Point 1.0. We are seeing an unfair playing field that results in disastrous consequences for legal businesses and law-abiding citizens. On one hand, if you were in the private sector and you do your job poorly, you would face consequences, reprimands, suspensions, or even being fired. But if you are within the walls of the federal government, such as a bank regulator, you will face no consequences for your actions, even if you pressure a bank to cut off services to digital asset firms, political figures, and conservative-aligned businesses and individuals. To me, that goes against the principles of fairness and market access. Over the last 2 years, As the ranking member of this committee, I have consistently argued that Basel III endgame proposal will raise costs and limit credit access for hardworking Americans. And while I'm glad this proposal was not finalized, the uncertainty surrounding Basel III forced banks to put capital on the sidelines, limiting access to that capital for local small businesses across our country. Now, as chairman, I plan to work to rectify the issues of the Biden administration. Chairman Powell, I look forward to hearing from you on the Federal Reserve's future and the plans that you have for right-sizing the financial regulatory framework, specifically around Basel III. To create jobs here in America, we need to make sure there's capital and liquidity in the market. And we also want all Americans, even those growing up in poverty like I did, to know that they can access the capital necessary to start new businesses, grow existing businesses, buy a home, and pursue their American dream. Chairman, I look forward to your comments and your testimony. I will simply say that I believe that weaponizing an independent agency like the Fed for liberal positions, from debanking crypto, bank stress test, and the green financing scheme, is not calling balls and strikes as a fair referee. And I hope that we are getting ready to clean that slate, start afresh, and focus on a healthy economy. Ranking Member Warren.
Thank you, Mr. Chairman. Chair Powell, it is no secret that you and I disagree on the need for strong bank regulation, on monetary policy, and on the Fed's stock trading scandals. We have sharp differences, but I believe you are a principled public servant who cares about this country. We are at an unprecedented moment. Our financial systems are facing huge risks from the economic chaos of President Trump and his co-president, Elon Musk. From on-again, off-again tariffs to on-again, off-again layoffs for tens of thousands of government workers, to on-again, off-again cuts in domestic grain purchases, to on-again, off-again support for medical research. Now, co-president Musk and his OMB director have frozen all work at the Consumer Financial Protection Bureau. There are now 0 cops overseeing the $18 trillion consumer lending market. 0 cops. Investigations into illegal foreclosures and auto repossessions canceled. Exams of giant credit card issuers to weed out unlawful junk fees canceled. Probes of illegal debt collection practices canceled. Rules to save people billions of dollars canceled. If Musk and his OMB director succeed in killing the CFPB, it's like putting a sign on every checking account, every credit card, every mortgage application, and every car loan. Cops have been fired. Let the scams begin. That is not all. Musk and his Doge crew are also rooting through the Treasury's most important payment systems, the financial plumbing that ensures that billions of payments go through, from Social Security checks to grants for community health centers. No one has verified how they got this access or what they are doing with it. No one has checked whether Americans' financial data has been copied or sold for the personal profit of Mr. Musk. Instead, we've had a series of misleading and conflicting statements by Treasury Secretary Bessent. After receiving public blowback, it appears that Secretary Bessent is now trying to throw the Federal Reserve under the bus. Secretary Bessent claims that Doge can't meddle with the Treasury's payment systems because ultimately the Fed is in control. Now, I'm not sure whether Secretary Bessent doesn't understand how the system works or if he's just trying to shift the blame to you. But I know he is wrong. The Fed simply executes the transactions that Treasury instructs. If Elon and his hackers, for example, initiate instructions to choke off payments to their enemies, or if they issue instructions to shut down payment for teachers' aides for kids with special needs, The Fed may have no way of knowing that the instructions were manipulated, and the Fed may have no legal method to override them. Chair Powell, the next 18 months may define your legacy and the country's trust in the Fed as an institution. I expect that you will work with Democrats and Republicans in Congress if DOJ's next move is to try to commandeer the Fed's payment system. I also expect that you will not join the conspiracy to shutter the CFPB. Unlike the Treasury payment instructions, you can see if the CFPB's funding requests have been manipulated. I understand that some extremists have a different view about what the law ought to be, but under the law right now, impoundment is clearly illegal. Do not make the Federal Reserve an accomplice to this illegal act and forever sully the reputation of the Fed. Keep the CFPB funded exactly as the law requires. We are in the middle of a crisis as Elon Musk tries to take over our government. But let's also talk for just a minute about your day-to-day job, meeting the Fed's dual mandate of promoting maximum employment and stable prices. It's now clear that the Fed acted too late and let inflation get too high, and then responded by keeping rates too high for too long. These policies made the big drivers of inflation, like housing costs, even worse. And they put Americans' jobs at risk, making it more difficult for them to afford a home and for small businesses to be able to finance their operations. I urge you to move more rapidly to bring down interest rates, beginning with a meaningful rate cut next month. You have proven you can move quickly when it is politically expedient. After President Trump was elected, within the space of just a few weeks, you scrubbed seemingly all mention of diversity and inclusion from the Fed's website. You withdrew from an international central bank group that shares information on climate-related risks to the financial system. You instituted a hiring freeze that will limit the number of cops on the Wall Street beat, and you announced plans to gut big bank stress tests. I can see the immediate political appeal of your strategy, but ultimately it will fail. You will lose good people. Climate catastrophes will continue to mount, and the increasing vulnerability of big banks will threaten our entire economy. Sure, Donald Trump may be happier with you right now, but wading deeper into politics to please him over the long run will burn the reputation and the independence of the Fed and put our entire economy at risk. I urge you, don't fall into these traps. Thank you, Mr. Chairman.
Yes, ma'am. Today we'll hear from Chair of the Federal Reserve, Jerome Powell, on the semi-annual monetary policy report to Congress. Chair Powell, thank you for your testimony today, and you are now recognized.
Chairman Scott, Ranking Member Warren, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. We are attentive to the risks on both sides of our mandate. I will review the current economic situation before turning to monetary policy. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose 2.5% in 2024, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have declined in the fourth quarter, but was solid for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid and appear to have stabilized. Payroll job gains averaged 189,000 per month over the past 4 months. Following earlier increases, the unemployment rate has been steady now since the middle of last year, and at 4% in January remains low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The strong labor market conditions in recent years have helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-term goal. PCE prices rose 2.6% over the 12 months ending in December, and excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. Since last September, the FOMC lowered the policy rate by a full percentage point from its peak, after having maintained the target range for the federal funds rate at 5.25% to 5.5% for 14 months. That recalibration of our policy stance was appropriate in light of the progress on inflation and the cooling in the labor market. Meanwhile, we've continued to reduce our securities holdings. With our policy stance now significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the FOMC will assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. We are attentive to the risks on both sides of our dual mandate, and policy is well positioned to deal with the risks and uncertainties that we face. This year, we are conducting the second periodic review of our monetary policy strategy, tools, and communications, the framework used to pursue our congressionally mandated assigned goals of maximum employment and stable prices. The focus of this review is on the FOMC's Statement on Longer-Run Goals and Monetary Policy Strategy, which articulates the committee's approach to monetary policy, and on the committee's policy communication tools. The committee's 2% longer-run inflation goal will be retained and will not be a focus of the review. Our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. We will take on board lessons of the past 5 years and adapt our approach where appropriate to best serve the American people to whom we are accountable. We intend to wrap up the review by late summer. Let me conclude by emphasizing that at the Fed, we'll do everything we can to achieve our dual mandate goals that Congress has set for monetary policy. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. Thank you. I look forward to your questions.
Thank you, Chairman Powell. Certainly your words and your actions have a global impact. You have the opportunity and responsibility of leading this country in the right direction economically, and I thank you for your commitment to having a conversation with all of us about how you do that well. You and I had a conversation yesterday. Some of it was frustrating, some of it was illuminating, but in the end, my goal is to make sure that the American people, and specifically those working paycheck to paycheck, have more opportunities to succeed, not fewer. You have said that the Fed is not against innovation, and banks are perfectly able to serve crypto customers as long as they understand and can manage the risks. Yet you have admitted that the threshold has been a little higher for banks engaging in crypto activities. Last week, I held a hearing on debanking and once again heard that federal banking agencies, in particular the Fed, use reputational risk as a tool to encourage the debanking of certain legal industries and law-abiding citizens for political reasons not tied to safety and soundness. Debanking is a top priority for this committee, and it certainly is for me, and one that I believe is a bipartisan issue. Will you commit to working with this committee to end debanking, including working with the new Vice Chair of Supervision, once appointed, to revise the Federal Reserve supervision manuals to remove reputational risk as a tool to weigh in on political topics?
I'm happy to make that commitment.
Thank you, sir. Accountability is very important. I would like to think accountability is a priority for everyone, especially the Fed, given that failures in Fed supervision can result in the loss of billions of dollars. Yet following the failure of the Silicon Valley Bank, which was in part due to the failures of its regulators to identify egregious mismanagement of interest rate and liquidity risks, we have yet to see any regulators be held accountable. And as you recall, that was a point of my frustration. As a guy who's spent a lot of time in the private sector, 15 years running a few businesses, I can tell you that accountability is a necessary part of making the entire organization healthier and perform its job as well as possible. I'm encouraged that the FDIC has begun the process of holding SVB executives accountable. That's good news. But no Fed employee has been fired, put on probation, put on performance improvement plan, all of which would be expected in the private sector, as I just mentioned, for employee failure. Please explain to me why Fed employees are held to a different standard from my perspective than everyone else, and what are you planning to do to take accountability for Fed failures in supervision?
So we've actually done quite a lot in response to the events associated with Silicon Valley Bank. So we've done many, many things. In terms of specific accountability, what we found was this was not a case of malfeasance or nonfeasance so much. It was a case of people were carrying out a specific playbook that failed to cause us to act in time for these things. So it wasn't actually particularly fair to the employees to say you violated our practices in some way. That wasn't really what happened. What happened was, I would say, a lot of focus on process and on governance and controls, and not enough focus on basic bread and butter banking, credit risk, liquidity risk, interest rate risk, things like that. So as we discussed yesterday, we took very substantial steps to avoid further spread of those issues, and that was successful. But I understand your point on accountability.
This is one of the areas where you see the approach of looking at safety and soundness, and with the number of MRAs that went really documented, but no action was taken, that leads me to the conclusion that individual employees, supervisors, should have been held account for that. I'll move on, though. In the past, you've supported tailoring regulations so that we ensure banks of different sizes thrive and to preserve our diverse banking system. Will you commit to working with me as chairman to make sure that financial regulations do not impose more burden than is necessary? And I'll say that this comes after a number of conversations with community banks and regional banks that have continued to stress that the cost of the regulatory framework around them isn't just harsh, it's oppressive. Larger banks suggest that the cost per employee for the regulatory framework is $10,000 per employee. I think we can do better, and would love to hear your thoughts on that.
Right, first of all, I will commit to working with you on that. We do try to avoid excessive burden. I think it's fair to take a fresh look frankly, on debanking. I think we all see, both in your hearing and in the one on the House side, we hear a lot of people talking about that. And, it's time to take a fresh look, I think. We don't intentionally do these things, but sometimes regulation leads things to happen, and we need to be working on that.
I appreciate that, and I'll turn over to the ranking member. I'll say this. after having a number of conversations with CEOs of banks around the country, one of the things that was made clear to me with specific statement from the CEOs is that the regulatory OCC and other regulatory agencies said specifically to debank certain industries, and that is the point that I'm making, and one that I think we have to solve. If it's legal in America to do business, we should do our part to make sure that they're banked.
Thank you, Mr. Chairman. So over the weekend, Co-President Musk and Acting Director Vogt effectively shut down the CFPB. No more cop on the beat looking out for a family of 4 in South Carolina facing an illegal foreclosure. No more cop on the beat looking out for your grandma whose bank account has just been taken over by a scammer. No more cop on the beat looking out for people getting ripped off by giant credit card companies that are charging illegal junk fees. It also means that the CFPB is no longer doing one of its most important jobs, examining big banks to root out illegal conduct before it happens, or at least stop it before more people get hurt. Chair Powell, if the CFPB isn't on the job right now, then who is administering JP Morgan or Wells Fargo's consumer compliance exams to ensure that they are following the law?
Senator, I believe that, and you would know, that Dodd-Frank moved all authority for examinations in the consumer space to the CFPB. We still have some jurisdiction.
We'll talk about that in a sec, but the answer to my question, please. If the CFPB is not there examining these giant banks to make sure they are following the laws on not cheating consumers, who is doing that job?
I can say no other federal regulator.
No one, in other words. So thanks to Co-President Musk and CFPB Acting Director Vogt, Wall Street banks no longer have to show the bank examiners that they're not illegally opening accounts people didn't ask for, like happened with Wells Fargo, or charging illegal junk fees like the Bank of America did. But CFPB has jurisdiction only on banks that have more than $10 billion in assets. So what's happening in thousands of community banks all around the country, those that have less than $10 billion in assets? So Chair Powell, as you know, the Fed oversees consumer compliance for state member banks that have less than $10 billion in assets. Has the Fed suspended consumer compliance exams for those smaller banks, or is the Fed still on the job to make sure that those smaller banks are following consumer financial laws?
Still on the job, business as usual.
All right. By forcing the CFPB not to do its job, President Trump, Elon Musk, and the author of Project 2025, Russ Vought, are giving Wall Street banks an unlimited get-out-of-jail-free card so they can cheat working families, even while community banks continue to play by the rules. You know, for any Americans who have money deposited at JP Morgan or Wells Fargo or any other of the giant banks, they should now know that there is no one on the job to make sure that those banks are not scamming you. Only the smaller banks now have a cop on the beat to make sure that they aren't cheating consumers. You know, if I have my money in one of those giant banks, I might think about going to a smaller bank where the protection, at least right now, is a whole lot better. Now, at the same time that the CFPB is under attack, the Fed is buckling to pressure from Wall Street to erase other safeguards for the too-big-to-fail banks. During the first Trump administration, under your leadership, the Fed weakened the big bank stress tests, including by giving the big banks some of the answers to the test in advance. I called you out on it, but you promised right here in this committee that you would not give those banks the whole answer key. I'm going to quote you back. You said, complete knowledge of the models could lead to a model monoculture in which all firms have similar internal stress testing models which could increase the correlation of risk in the system and miss key idiosyncratic risks faced by the firms. I agreed with you. But several weeks ago, the Fed announced that it has plans to do exactly that, hand all of the answers over to the giant banks. Chair Powell, why is the Fed about to propose a rule that directly contradicts your own testimony and, in your own words, would render the stress tests toothless?
Senator, in essence, because the ground has shifted very substantially in administrative law, and we actually want the stress test to remain resilient to that, and so we're making changes to accomplish that.
Well, the changes are changes you've identified earlier as making those tests toothless. Look, the big banks are going to juice shareholder payouts and leave this economy more vulnerable to a crash. The Fed is knuckling under to bank lobbyists. We know how this ends. People will suffer. Wall Street will get bailed out. I urge you, Chair Powell, to serve Main Street instead of Wall Street. Don't weaken these rules.
Thank you. Senator Rounds.
Thank you, Mr. Chairman. And Mr. Chairman, thank you for coming before the committee. I appreciate the opportunity to visit with you. I've got a series of questions, but I would like to give you an opportunity, if you would like. The suggestion that the ranking member has made here is that the big banks can now scam individuals right now. Any change in the laws regarding how they're supposed to be treating the individual consumers out there or anything along that line?
Law changes? No, I'm not aware of any
Any
law
changes,
changes.
any rules that they would have to follow?
Not that I'm aware of.
Are they still audited, and do they still have the regulators in watching all of their businesses just as they did before?
Well, they'd have all the regulators except for the CFPB.
Very
If in fact, in the hypothetical, the CFPB weren't carrying that out.
Anything else you'd like to add before we move on?
No, I'm good. Thank you.
Thank you, Mr. Chairman. As we continue to prioritize the stability and the resilience of our financial system, the ongoing Basel III rulemaking process has remained front and center in shaping our regulatory framework. Now, I guess I was rather outspoken with my opposition to the original proposal, and further work was stalled at the end of the last year. I guess my question for you today, sir, is could you provide an update on the Federal Reserve's progress in finalizing the Basel III endgame rulemaking process?
I'd be glad to. So we remain committed to completing Basel III endgame. We think it's good for U.S. banks, it's good for our economy that there be a global standard beneath which foreign banks can't fall. And that was one of the big ideas behind the whole Basel Committee approach. So where it sits now is we await leadership arriving at the OCC and the FDIC, and that seems to be happening. And when that happens, we're going to sit down with them and work our way through to a Basel III endgame proposal. And I think we can do this reasonably quickly, one that is compliant, consistent with the Basel requirements, and also consistent with what other large jurisdictions are doing. I'm optimistic that we can do that fairly quickly, and we're committed to doing that.
We always wanted our banks to be competitive with European banks, and I'm just curious, the original proposal that was in front of you, and I'd like your thoughts on this, it was estimated to increase our bank's capital by 19%, which I think may very well have created a potential disadvantage within the U.S. institutions versus our European counterparts. With any new proposal, what's your thoughts? Would you make a commitment that this would be a neutral approach with regard to capital?
The main commitment I'll make is we'll work together with new leadership at the other banking agencies to do something. But that's certainly, you know, I've said many times in this committee that I think that the level of capital in the largest banks is about right, and so it'll shake out somewhere in that area, I would guess.
Our expectation would be, and the markets would expect, that it would be neutral with regard to capital.
In that range, but I want to defer to our new colleagues and get their views as well. But that's a good starting place.
Okay, thank you. The Federal Reserve's partnership with the U.S. Treasury plays a central role in supporting our nation's payment infrastructure, which processes a vast range of daily transactions, from federal benefit disbursements to debt obligations. Could you outline the Federal Reserve's role in supporting and managing the Treasury's payment systems, including how the Fed works to keep these systems secure, efficient, and capable of handling the government's high volume of daily transactions?
So it's a complicated set of arrangements, and I'll try to summarize quickly. Effectively, Congress authorized spending, and then the agencies carry out those spending orders. And when the way they do that is they send an order to pay a payee, a recipient, to the Treasury Department. Upstream, before it gets to the Fed, all of these decisions are made about, is this an appropriate order? Is this payee on the don't pay list, and all those things. Once all of that is set, it comes to the Fed, and by that I mean 4 or so of the reserve banks, and we actually make the payment. We take the money out of the Treasury General account and we make the payment. We make no judgments whatsoever. Those are all made upstream from us, and we are in fact the fiscal agent of the Treasury.
Confirm for me today, is the system safe today?
I believe it is, and I will tell you, we are very strongly committed to the integrity, efficacy, resilience, and all those things of this system. And people do depend on this in a big way, and we're committed to that.
One last question for you, sir. The failure of Silicon Valley Bank, and the chairman brought this up. I'm just curious, recognizing a lot of banks out there looked at this, it cost the other banks in the system a lot of money to pick up the costs involved in the losses. Nobody's been fired. But you did indicate that it was a failure in the playbook. Has the playbook been revised, or can we expect that it will be revised?
In a lot of ways, it's been revised, yes. I can go into some details. I mean, one thing that didn't happen was, for example, the supervisors didn't follow through aggressively enough on things that they'd said. If they'd done that could well have been enough to stop it. But a lot of it was just not focusing enough directly on what was a very large amount of interest rate risk, a large portfolio of long-term securities matched up with an unstable funding base. And somehow people wrote about that, and not the Fed, but others wrote publicly about this, but somehow we don't expect bank runs outside of a crisis in this country, and that's what that was. It was a bank run, and bank runs are incredibly damaging. I think everyone learned a lot from that and is determined to do better.
Thank you, Mr. Chairman. I think this is one that I think, as you appropriately pointed out, I think this is an area where a lot more questions are out there yet, and I think if it's the playbook that was the problem, I think perhaps a discussion about how that playbook has been revised would be appropriate in the future. Thank you, Mr. Chairman.
Thank you. Senator Cortez Masto.
Chairman Powell, thank you, and thank you always for the conversations in between these hearings as well. Let me focus on a couple of things of concern, and you touched on a little bit of this, and I think this is important to clarify. There was a change in the law when the CFPB was created. The CFPB examines the banks and enforces the law, whereas the Fed only supervises those banks. Is that correct? Or how would you determine that relationship?
With the CFPB? So Dodd-Frank took a lot of the consumer compliance jurisdiction away from the other banking agencies and gave it to a newly created agency, the CFPB. We retained a residual amount of that, as we just discussed, which was banks under $10 billion in assets. But the CFPB essentially took all of that when Dodd-Frank came into being.
So as it was created, when you two were working together, the Federal Reserve collaborated with the Consumer Bureau when supervising those large banks, correct?
Yes, we still retain supervision over all the holding companies and also of Fed member banks.
And let me ask you this then, does the Federal Reserve enforce consumer protection laws now for things like money transmitters?
Not for money.
That would be the consumer protection. That would be CFPB.
Yes, yes.
Okay.
That's
And
right.
so when we're talking about collaborating with the CFPB for financial technology firms, what would the Fed Reserve now do that if the CFPB, if the hypothetical is the CFPB no longer exists, what would be the Fed's role right now with respect to technology firms?
We don't have jurisdiction over, we have jurisdiction over banks and some
And
financial
that's
market
it.
utilities.
So let me ask you this, because I know there's a number of Nevadans who file consumer reports of concerns about fraud and predators with the CFPB. The Fed Reserve doesn't receive those reports, correct?
No, I don't believe so.
And you have no role when it comes to consumer protection like the CFPB does, correct?
Unless you're a a Fed member bank that has 10 billion or less in assets, then we have jurisdiction
Right.
on a
So there
consumer.
is a gap. If the hypothetical is true, and what we're hearing, that the CFPB is being shut down, there is a gap, what we're hearing in enforcement out there, and particularly when it comes to consumer protection. Is that, would you say that's true?
Yes, for all banks that we don't
Yeah.
supervise.
And I think that's the concern we're all having right now, is this concern of when we're looking to streamline government. And listen, I'll be the first to tell you, there's a lot of bloat. We need to streamline it. We need to address regulations and overreach. But there's a strategic way to do it, and not this burn down the house that is going to harm people across the country, including in my state, those Nevadans that are looking for some sort of enforcement around consumer protection law. So that's what you're hearing from many of us on our side of the aisle here.
Can I just very briefly add that we do have some residual enforcement authorities, but what we don't have is examination authority, and for the banks that the CFPB supervises.
Thank you. Let me ask you this, and you know, we talked about this over the phone, and I understand it may be difficult to answer this, but the Federal Reserve Board members have been clear that future interest rate cuts are unlikely to happen despite the strong economy. But there are folks in my home that are in my state that are waiting to buy a home. And we know that's still an issue, the high prices right now for home affordability. You add the interest rates to it, it is a problem. So do you think it's most likely that interest rates will remain above 6% for this year, or can you even address that?
You know, so overall, the economy is strong, growing 2.5% last year. The labor market is also very solid. Unemployment at 4%, quite a low level. Inflation last year was 2.6% for the year. So we're in a pretty good place with this economy. We want to make more progress on inflation, and we think our policy rate is in a good place, and we don't see any reason to be in a hurry to reduce it further. As it relates to housing, so it's true that mortgage rates have remained high, but that's not so directly related to the Fed's rate. It's really related more to long-term bond rates, particularly the Treasury, the 10-year Treasury, 30-year Treasury, for example. And those are high for reasons not particularly closely related to Fed policy. They may remain high. I think, you know, once we lower rates and kind of rates return to a lower level, mortgage rates will come down. I don't know when that'll happen. And even when it does happen, we're still going to have a housing shortage in many places.
Thank you. Chairman Powell, thank you again for being here.
Thank you, ma'am. Next will be Senator Kennedy.
Thank you, Mr. Chairman. Thank you, Mr. Chairman, for being here.
Okay, great. Yes, ma'am.
My friend, our ranking member, said that you are knuckling under to the big bank lobbyists. Is that true?
No.
It seems to me that the big picture should not go unnoticed. Do you recall a year or two ago when inflation was raging? I think its peak was about 9%. Many economists and other experts, based in part on history, said that you were going to have to provoke high unemployment and put our country into recession in order to get inflation down. Do you recall that?
Very, very well.
Are we in a recession?
We are not.
Would you, as an American, trade places right now with Germany in terms of the economy?
No, I sure wouldn't.
How about China?
No, wouldn't trade places.
How about France?
No, thanks.
Things aren't perfect. Inflation's obviously still sticky, and long rates are too high, which I want to talk about in a second. But the fact is, knock on wood, we have experienced a soft landing, haven't we?
Not for me to say, really. I'll let others
Well,
make
have we
that.
experienced a hard landing?
No, we sure
Are
haven't.
we in a recession?
No, we're not.
I call that a soft landing. And it seems to me that you and some of the ladies and gentlemen who are your colleagues at the Federal Reserve behind you deserve some credit for that.
Thank you.
I don't know why you don't take the credit. Everybody else in Washington, D.C. does. Again, I'm not saying things are perfect, but I never imagined that our landing could be this soft, albeit not perfect. And I wanted to thank you and your colleagues for that effort. You sure didn't get any help from Congress and on the our president on the fiscal side. I don't expect you to comment on that. You and the Federal Reserve can to a large extent control short rates, can't you?
Yes.
Through the Open Market Committee. You can't control long rates, though, can you?
No, we can't.
Why is that?
So a lot of things go into long rates, and one of them is the expected future short rate of Fed policy, but many, many other things go in. Expectations of inflation in the longer run, the sort of risks around the economy and around the budget deficit go into something called the term premium, which is the part we can't explain when we do these decompositions. And so, you know, it's set by supply and demand in the bond market at the long end, and we're not particularly. We have some influence, but mostly not.
Many Americans are looking at short rates and looking at the Fed's behavior and how you reduce inflation, but they don't seem they don't see the long rates going down, and obviously that affects mortgage rates. And I would encourage you and your colleagues to spend some time explaining to the American people why that is. Final question. If you went home tonight and Mayor Powell, your spouse, said, you know, I got a call today from our bank, and they're debanking us. They're worried about their reputational risk because they don't like our politics. Would you think that fair?
No, I sure wouldn't. And as I mentioned earlier, I too am troubled by the quantity of these reports, and you know, really want to understand better why this is happening. You know, one theory is that banks are just very risk averse around BSA and money laundering, and that's because we're so tough on them and that they just don't. Any red flag is enough. But you know, it may be that this whole thing with reputation risk needs to be thought about. It's actually coming out of our one manual that we use. We're taking that concept out, the manual that we've been using for account access for master accounts. We're just going to take that out. But I think this needs a fresh look, and I think it's time for that, and we're going to do that.
Well, I've asked our chairman, and he has agreed to invite some of the CEOs of some of the banks that have been debanking people. The CEOs,
Yes.
not their lawyers, not their PR consultants,
Not the lobbyists.
not their priests, them, the CEOs to come in and let's talk about this and find out what the hell's been going on.
Thank you, Senator Kennedy.
Thank you, Mr. Chairman.
Senator Reed.
Thank you, Chairman Scott. Chairman Powell, welcome. Thank you very much. I think your monetary policy combined with the Biden fiscal policy over the last 4 years has made a tremendous difference. We've avoided a recession. And I'd like to remind people how far we've come. In 2020, the gross domestic product decreased 2.2%. The unemployment rate finished the year at 6.7%. By 2024, Gross domestic product grew 2.5%. The unemployment rate was 4.1%. Labor force participation rate went up from 61% to 62.5%. And that's a combination of your work together with the fiscal policy of the Biden administration. So I thank you for that. One of the issues before us today is the issue of tariffs. In July 2018 testimony, you stated, Mr. Chairman, countries that have remained open to trade, that have not erected barriers, including tariffs, have grown faster and had higher incomes. Do you still believe that?
Yes, I do. I would stand by that.
So President Trump's tariffs on China, Canada, and Mexico will obviously raise costs on families. In fact, some economists, many economists, project about $1,200 per year households will be paying extra, an increase of inflation by nearly 1%, economic growth depression, and, for example, the increase of the average car price by $2,700. Is that a wise policy?
So I guess I ought to say this. You know, I think the standard case for free trade and all that logically still makes sense. It didn't work that well when we have one very large country that doesn't really play by the rules. And in any case, it's not the Fed's job to make or comment on tariff policy. We, you know, really, that's for elected people, and it's not for us to comment. Ours is to try to react to it in a thoughtful, sensible way and make monetary policy so that we can achieve our mandate.
Just this weekend, the president removed the board of the Kennedy Center and made himself chairman. What would you do if the president tried to remove a member of the Federal Reserve Board?
Well, it's pretty clearly not allowed under the law.
Thank you. We've communicated back and forth about synthetic risk transfer as a potential danger to the banking system. And could you give us some insights on how we can improve financial stability by regulating these transactions more appropriately?
So what we've been doing for some time now is looking at them on a case-by-case basis. And if they really do transfer risk successfully, then that's okay. I mean, you know, it's a good thing if a bank wants to transfer risk off its balance sheet in a way that it gets compensated for and all that. But what you want to make sure is that the risk is really transferred, and that was the problem during the global financial crisis. Was sort of things that appeared to but did not accomplish a transfer of risk. So we see this coming, and we've been looking at these transactions on an ongoing basis.
Well, I commend you for that. In fact, what happens typically is the transaction becomes complicated by synthetic risk transfers, as it was the case with synthetic derivatives. So thank you for your attention to that. We've talked about housing. It's absolutely critical everywhere across the country. We're in a housing shortage. Of course, while housing is difficult, two of the mainstays of our housing market are Fannie Mae and Freddie Mac, helping to support home ownership. Does the federal guarantee backing Fannie and Freddie help make mortgage rates more affordable and home ownership more accessible, Mr. Chairman?
I imagine it does hold down mortgage rates, the fact that they're sovereign risk.
And how important is the 30-year mortgage to ensure that families can afford a home?
In our housing market, the 30-year mortgage is very important.
Yeah. And I have heard some discussions about eliminating Fannie Mae and Freddie Mac, which would be detrimental, I presume, to the housing market.
That's really a question for you. You know, I mean, putting them back in the private, putting housing finance back in the private sector has some appeal over the longer run, but I leave that with you.
Thank you, Mr. Chairman, very much. Appreciate it.
Thank you. Senator Ricketts.
Well, thank you, Mr. Chairman and Ranking Member, for holding this important hearing, and thank you, Chairman Powell, for being here today to talk about our economy and all the things that are going on. I want to address, again, something that the Ranking Member started talking off about, which was characterizing the CFPB as being the cop on the beat here. But I can tell you, as having been a governor and having a Department of Banking that reported to me, that if any consumer would contact us and make a complaint about a bank, even a big bank like JP Morgan, we would investigate. as could the OCC, the FDIC, the FTC. So to characterize that nobody's out there looking for consumers, I think, is inaccurate. And we ought not to try and scare consumers right now that somehow this is the case, because if you do have an issue, if you're a consumer, please reach out to your State Department of Banking, because those folks are going to look out for you. I can tell you that because I used to have one of those Department of Bankings. They did a fantastic job of looking out for the consumers. One of the things that has also impacted consumers is inflation. Prices under the Biden administration were up 20%. An average household is paying $13,000 more today than they were for the same standard of living they had before Joe Biden got elected. We see that grocery prices, for example, are up 22%, rents up 23%. Simply put, Nebraskans are economically worse off today than they were 4 years ago, and I expect that that's part of the reason why we saw this change in the administration. They thought that that was not something that they wanted to continue to pursue. They didn't want the same policies being followed. We have to end the reckless federal spending, rein in inflation, and be responsible about how we make decisions to be able to grow the economy. One of those areas that I'm concerned about is the expansion of the Fed balance sheet. The Fed's balance sheet before, at the end of 2019, so before the pandemic, was about $4.1 trillion. By May of 2020, the Fed expanded that to $7 trillion, and by 2022, the Fed's balance sheet hit an all-time record of $8.9 trillion. Inflation peaked at 9.1% that year, a high we had not seen since 1981. Now, I'm encouraged by the actions the Fed has taken with quantitative tightening to shrink the balance sheet down to $6.85 trillion, but $6.85 trillion is still too high. And one of my concerns with this, Chairman, is that that's kind of one of your tools to be able to guard against a downturn in the economy or some sort of shock. You obviously used it during the pandemic. Looking ahead long term, will the Fed Reserve continue to this course of unwinding the balance sheet?
Yes, so what we said is that we intend to slow and then stop the decline when reserve balances are somewhat above the level that we judge consistent with so-called ample reserves. The most recent data and the feel of the markets is definitely that reserves are still abundant. They're about the level they were at when runoff started, because the runoff has really happened out of the overnight repo facility, reverse repo. So yes, it's an ongoing thing, and we're not yet where we're headed.
So what kind of pace can we expect? And I know that obviously there's going to be a lot of factors like what happens to the economy over the course of next year. But if things were going to go along the way they are today, you've already said the economy's doing well. Inflation's a little higher than we want it to be at 2.6%, but unemployment's at 4%. If these commissions, and I think you used the word stable quite a bit, if these conditions were to remain stable throughout the course of the year, would you have a range that you could give us of where the balance sheet might be if we were talking again here in January 2026?
We basically we're going to be looking at reserve conditions in reserve markets, and trying to stop a little bit above what we consider ample. And we think we're meaningfully above that now. We can't put a number on it because you can't directly know the demand for reserves other than by observing behavior in the market and then putting a little bit of a buffer on it. So I can't give you an exact number, but for now it's ongoing, and we have a ways to go.
What kind of conditions would have to happen for you to start going back to quantitative easing?
So to quantitative easing. That's a tool we tend to use when we're at the effective lower bound and we can't cut interest rates anymore. So nothing like what you're seeing in the current day. It's a different test for stopping quantitative tightening, but we would use QE going forward only in a situation where rates are at zero, and we're a long way from zero now.
So that you think that, again, just generally speaking then, if things were to remain stable, you'll continue to unwind the balance sheet, you'll continue the quantitative tightening. Can't give me a range on this? Is that what I hear you saying?
That's right. That's right.
Okay, great. Well, I encourage you to keep doing that because, again, I think that's important to be able to make sure that you've got powder for the next issue that we may face. So thank you very much, Mr. Chairman. Appreciate you being here.
Senator Warner.
Thank you, Mr. Chairman. Chairman Powell, good to see you. One of the things we've talked about in the past, and I've got 2 or 3 issues I want to get through fairly quickly, is that that while our regulatory framework should always promote financial innovation, that innovation can't come at the expense of things like anti-money laundering, consumer protection, financial stability. I continue to worry, in many of these hearings, where we keep seeing this regulatory creep outside the boundaries of traditional financial regulation. I think if we were starting a system from scratch, few of us would design it this way. But it is one of the reasons why I'm looking forward to working with Chair Scott and my colleague, Senator Lummis, on a framework at looking at stablecoins in particular within the regulatory perimeter. I know my friend Bill Hagerty just introduced a bill in this area. I'm looking at trying to make sure we get those guardrails put in place, and how it touches the Fed is something that's terribly important to me. I know you and I have talked in the past about the notional idea of same activity, same regulation in the non-bank sector. If you'd like to wax briefly on this question around stablecoins and how we think about them in the same point of, if they are similar to other activities, should they not have the same regulatory structure?
So we definitely support these efforts to create a regulatory framework around stablecoins. Stablecoins may have a big future with consumers and businesses. We can't know that now, but it is important for the development of stablecoins in a safe and sound manner, and a manner that protects consumers and savers and all, that there be a regulatory framework. So we see these bills, and we're in contact as we were in the last Congress, and trying to add our technical thoughts and how to do this. And we think it's a very constructive exercise.
Well, we do think, you have a lot of expertise in this session, and there are people people come with lots of opinions on everything in crypto, from over the top to the other end of the spectrum, and I'm gonna need to rely on your expertise as well as we try to work through some framework for stablecoins. I know there are a lot of earlier questions on CFPB. I think the record is pretty darn good. It's returned $20 billion to consumers. Matter of fact, the last time we had the previous chair here, Chair Rohit, Ms. Chopra, we were talking about $55 million to Virginians. I do have to mention this more for my colleagues. Tim Kaine and I did a teletown hall last night. Lots of things happening in Virginia. Normally, we would get maybe 3,000, 5,000, 6,000 folks on a teletown hall. We had 60,000 last night. I have not seen anything like that in my time up on here on the Hill, and a huge amount of concern about what the Doge boys are doing, whether our information is safe, whether privacy is protected. I had one lady say, in light of what was happening at CFPB, and while there's not a direct connection, she's saying, is her deposits at her bank safe? We tried to give her a assurance, but I said, you know what, ma'am, I'm going to be talking to the chairman of the Federal Reserve tomorrow. And with this diminution or shuttering, at least at the time being, of the CFPB, can I tell, I believe her name was Mary, can I tell Mary from Virginia that her bank account is safe?
I think bank accounts overall across the economy are safe, yes. We've still got deposit insurance at the FDIC, and the banking system is well capitalized and safe.
Well, again, I think the concern was being raised was that the diminution of consumer protections lent her concerns about whether that dollar being safe. Last thing I want to recognize is that, there's been reports in the media about the thinness in the Treasury markets, the number of additional bonding that we're going to have to do, particularly with so many of these unpaid tax cuts. Matter of fact, one of the things that was really striking to me was that yesterday the president mentioned how he was, quote, examining Treasury debt payments for possible fraud, and suggested that our debt might not be as high as possible. We all understand the full faith and credit of the United States is based upon a reputation. If this president were to suddenly say, I'm wiping off X amount of debt because I don't believe we owe it, what kind of effect would that have on both stability of the dollar and the overstability of our economy?
It will probably not surprise you that I will defer to you on that question.
So you think it would be, from a Fed standpoint, the President of the United States starts to saying not going to pay our Treasury debt, you're going to have no view at all?
I'm not going to comment on things that the President says.
I would like to see us at some point get a stronger answer on that, because I think that in light of the President's willingness to shut down agencies willy-nilly, his ability to potentially curtail payment of debt, I think would have devastating consequences on our economy. Thank you, Mr. Chairman.
Senator Britt.
Thank you, Mr. Chairman. Obviously, there's been a lot of conversation both in and out of this hearing room today. Conversations about a co-president referencing Elon Musk, referencing the work that DOGE is doing. I think it's important to remember that President Trump ran on this. I mean, he said we're going to look for wasteful spending across our government. We're $36 trillion in debt, y'all. That's not only fiscally irresponsible, it is actually morally irresponsible. And the difference in this administration and the last administration is that President Trump is actually the final arbiter. And it's interesting that none of you had anything to say over the last 4 years when it is clear that our commander-in-chief was not in command. And if we're going to use the term co-president, then let's go back and say co-president Jake Sullivan, co-president Ron Klain, co-president Jill Biden. I mean, it seems that some of the biggest decisions were made during the president's afternoon nap time. And so I just think we need to be a little bit more honest about what's been laid out and what's actually occurring. Chair Powell, I want to discuss some monetary policy issues, but I first want to highlight a few supervisory items. We unfortunately started 2023 with several bank failures in which the Fed itself admits its supervisors were, quote, too slow to ask. The question has been asked earlier about who was fired, who was not. I think that there's some real merit to having accountability that we have not seen there. In the aftermath of those failures, the Fed was certainly not slow to act when it came to new regulations, like the new capital requirements that would have put the U.S. banks at a global disadvantage and actually hurt consumers in my state. The way I look at this is the world came up with a gold standard, and then Vice Chair Barr said, hold my beer. And unfortunately, that hurts Alabamians. In addition to that, we had Community Reinvestment Act and stress testing frameworks that were basically adopted in secret. Or as we discussed last week, the reputational risk and just the arbitrary nature of that and those standards that were used to push political agendas. None of this is acceptable, and we've got to take a look at how to promote greater accountability and transparency into the Fed's supervisory function. Shifting gears, as of January 30th, the Federal Reserve had a mark-to-market loss on its balance sheet of roughly $221 billion. In fact, I looked back and the Fed has posted losses since September of 2022. Meanwhile, we've seen transfers to the CFPB totaling $2 billion since September of 2022. So just to clarify, Chair Powell, these money transfers are requested by the CFPB director each quarter and then directly deposited by the Fed. Is that how that works?
So the director of the CFPB requests money, and we, under the law, we send that money, yes.
So, in fact, but Dodd-Frank actually prohibits the Fed from actually reviewing or amending those requests.
That is correct.
And so it gives full discretion to the CFPB director.
Up to, I think, 12% of our, there's a ceiling on that, but that's correct.
So just to level set, how many times, has the CFPB funding request been denied by the Fed?
We don't have the authority
Zero.
to deny it under the law.
Zero, right?
Zero, yeah.
Yeah, that's what I thought. And by the way, I'd like to applaud the current administration and acting director Vogt for inserting some accountability back into the agency by pausing these quarterly just blank checks. On that, I know there's been a lot of conversation around the Bureau over the last few days, but I do want to focus on those last couple of years, particularly the $2 billion the CFPB received from September 2022 up to the last receipt on January 2nd, 2025. Congress specified in statute that the Fed shall fund the CFPB through the combined earnings of the Federal Reserve System. However, as I mentioned, the Fed has no current earnings. It has a balance sheet of negative $200 billion. So instead of the recent audit statement saying the Fed is funding the CFPB through assessments on its reserve banks, Mr. Chair, there are only 2 statutes that authorize the Fed to make reserve bank assessments, and neither permit the CFPB to fund transfers. So what authority exactly did the Federal Reserve have to assess the reserve banks in this manner over the last 2 years? I just wanted kind of a fact-finding.
We looked at that question very carefully, and it's very clear on the law and the legislative history that we're still required to make those payments to do so.
Appreciate it. Thank you.
Senator Van Hollen.
Thank you, Mr. Chairman. I would point out that candidate Trump did not run on implementing Project 2025. In fact, when he was asked on the campaign trail about Project 2025, he said, I don't know anything about that. Who are those people? And yet he early on and quickly installed a key architect of Project 2025, Russ Vought, as the head of the Office of Management and Budget, which we know is the command and control center for the budget overseeing all federal agencies. And that's what Elon Musk is doing now. He's implementing Project 2025, the same Project 2025 that candidate Trump said he knew nothing about. And he said that because he knew it was unpopular. He knew it would be unpopular to take the financial cop off the beat. And I want to start by talking about what's happening over at CFPB, the Consumer Financial Protection Bureau, because that is the cop on the beat to go after fraudsters and scammers who cheat Americans out of their hard-earned money. And they have returned billions of dollars to our constituents, to the consumers who have been victims of these scams. And in doing so, they've earned some powerful enemies who want to shut them down. And Elon Musk is doing that dirty work on behalf of those fraudsters. And there's something especially twisted about the richest man in the world shutting down an agency that helps victims of scammers and fraudsters recover just a little bit of their hard-earned money. And I find it especially interesting that the new self-declared head of the CFPB, Russell Vought, told employees not to come into the office and essentially to stop work. Here's what he wrote, and I'm quoting, "Employees should not come into the office," unquote, and stand down from performing any work task, unquote. So this is an interesting situation. Federal employees continue to get paid, but the Trump administration tells them to stop doing their work. That apparently is what the Trump administration thinks is a good deal for the American taxpayer, to pay employees to not to do their job. So, Mr. Chairman, I have a simple question for you. Is that a practice that you pursue at the Fed, to pay your employees but tell them not to come to work? Have you done that?
No.
That wouldn't be very efficient, would it?
No.
No, it wouldn't. And yet, that's what the so-called Doge boys, efficiency boys, are doing. In addition to that, they're rummaging through the private, very personal, sensitive information of Americans at the Department of Treasury. So it seems to me that the Trump administration and Elon Musk are focused on everything except what Donald Trump said he was going to focus on during the campaign, which was to bring prices down. And when you look at the price of eggs these days, I noticed that Waffle House just instituted a new 50-cent per egg surcharge due to the nationwide rise in the cost of eggs. They said that's going to be a new surcharge, and other restaurants are following suit. You've seen that, right, Mr. Chairman?
Yes.
Yeah. And at the same time, the Trump administration has restricted federal agencies from providing the public with information about the bird flu, avian flu, which is part of the cost of egg increases. So what we're really facing here is an administration that campaigned on bringing down prices and is not doing that, did not campaign on Project 2025, and that's what they're doing. But when it comes to prices, Mr. Chairman, the president's also talking about significant increases in tariffs. Our Republican colleagues are also talking about passing a tax bill that gives weight disproportionately to the super wealthy and which will add trillions to the deficit by their own account. They're talking about playing around with the baseline. So my question to you is simple. All things being equal, do big increases in tariffs and increasing the deficit and debt put upward pressure on inflation? Isn't that simple math?
You know, it really does remain to be seen what tariff policies will be implemented, and I just think it would be unwise to speculate when we really don't know. I mean, we see proposals, but it's so hard to say what's going to happen. And
Well, last time the Trump administration was in office, the Fed took actions because they were concerned about the impact of increasing tariffs. Isn't that the case?
we wound up cutting rates in 2000 and I guess it was 19, but it really was because growth slowed and confidence was weak and the global economy was weakening. So the net effect of all that's what we look at. And it's really not just tariffs, it's tariffs, immigration, fiscal policy, and regulatory policy. And those will all go into a mix, and we'll try to make sense of it and do what's right for monetary policy.
Well, if you could just get back to me, I'm not on the question of increasing the deficit by trillions of dollars and what impact you believe that has on inflation and prices. Thank you, Mr. Chairman.
Yes, sir. Senator Lummis.
Thank you, Mr. Chairman, and thanks, Chairman Powell, for being with us today. I think you're aware of what direction my questions will take. They will be focused on the bank supervision function of the Fed. And I'd point out that when you and I were toddlers, 1956, the chairman of the Fed at the time, William McChesney Martin, said that the Federal Reserve Board is an agency of the Congress. Ben Bernanke said something similar in 2013 when he told Janet Yellen that, quote, Congress is our boss. Do you agree with that statement?
Yes, the way I always say it is that our supervision, our accountability runs through the legislative branch, not through the executive branch, as it does in many other forms of government.
Thank you for that, because I wouldn't have guessed that that was going to be your response. The way that the Fed has behaved for the last 4 years in its relationship with the U.S. Congress is to thumb its nose at Congress. Your staff has repeatedly stymied information requests from this committee, notably made by myself, the chairman, the ranking member, Senator Tillis, former Senator Pat Toomey, and others. In my experience, the Fed is a black hole. It consumes information, but it never releases it. Your fellow governors have personally misled me on at least 2 occasions with respect to Wyoming and digital assets. And in recent federal court filings, former Senator Pat Toomey has accused your staff of lying to him while providing technical assistance on legislation that passed in the National Defense Authorization Act in 2022. Now, I have behind me a statement by the Fed's General Counsel, one of the staff that's sitting behind you today, who said, quote, the Fed generally resists legislative prescriptions. Now, to me, that's thumbing his nose at Congress, the very people that you and I just agreed you are responsible to and the people depend on. So this is why the American people think there's a deep state. This is why they think there are faceless bureaucrats making policy to hurt the very people of this country. Just look at the mess the Fed made of Silicon Valley Bank. And I contend that there is a lack of understanding that is deliberate on the part of the Fed with respect to digital asset policy. So the Constitution says Congress is your boss, but somehow your staff have not gotten that message. So, Chairman Powell, do you commit on behalf of yourself and the Federal Reserve staff to comply fully with all document demands issued by this committee in a timely manner?
Sure.
Will you instruct your staff to be complete in their responses and not to obstruct the oversight functions of this committee?
You know, we always work with the committee to be responsive to your requests. Sometimes they're beyond our capacity to respond to, and we work with committee and with committee staff to do that, but we're always responsive to committee requests.
And I'll look forward to engaging with you when you feel that our requests are outside of the scope of the oversight that we have over the Fed. Do you commit to disciplining or removing any staff that are found to have engaged in debanking activity furthering Operation Choke Point 2.0 or other misconduct?
I can't make an open-ended commitment to remove anybody, but I will tell you that I am struck, and my colleagues and I are struck by the growing number of cases of what appears to be debanking, and we're determined to take a fresh look at that. In fact, I took the thing that you showed during the debanking hearing. When I saw that, we're now taking that out of the manual. So I thank you for that.
Thank you, Mr. Chairman. My time's up.
Senator Smith.
Thank you, Mr. Chair and Ranking Member, and thank you, Chair Powell, for being with us today. I appreciate your presence here. I'd like to start with the issue of the rising cost of home ownership, something that I know is of great interest to many of my colleagues on this committee. I know, Mr. Chair, that you care a lot about home ownership and making home ownership accessible and available to folks. My colleague, Senator Lummis, as well, many of the folks on my side of the aisle as well. And so I think this is something that we can agree on, that the rising cost of home ownership is a big challenge for our constituents, for Americans. And one of the big pressures, there are many, but one of the big pressures is the rising cost of home insurance. In Minnesota, families, seniors are struggling to manage a nearly 40% increase in home insurance rates. We've seen this over the last 7 years or so. And I know, Chair Powell, that you've told this committee in the past that that rising cost of buying insurance for your home has been a source of inflation as we've been trying to manage inflation. Now, I don't know anyone who doesn't see this crisis of rising insurance rates as being caused by extreme weather events. We've seen massive flooding in the southeastern United States. We've seen flooding in Minnesota. We've seen fires in the Mountain West in California. I mean, these are climate-related events. That's not a political position. That is just a fact. So, we've got banks that of course, require, understandably, that a homeowner provide insurance as a predicate for getting a mortgage. So there's a big question about what's going to happen when insurance becomes unaffordable, or in some parts of the country, just literally not available, and what impact that would have on the mortgage markets, on the value of American homes. Just last week, a new analysis from First Street showed that overall, the value of U.S. real estate could be reduced by $1.4 trillion, colleagues, over the next 30 years due to unaccounted for climate risk. That's the cost, the risk of not being able to afford home insurance because of these extreme weather events. And the prospect of trillions of dollars of property become uninsurable is clearly a recipe, it seems to me, for market instability, both in the rental as well as the mortgage market. So my question, Chair Powell, is given these trends, how do you think the Fed and how do you think we should be thinking about the challenges that these events are going to pose to insurance markets and to the overall financial stability of the economy? I'm asking you to comment specifically on climate change because I understand my colleagues on the other side of the aisle see that as a political question. It's more like what you see as the risk to financial stability here.
So let me quickly note that we don't regulate or supervise insurance companies for the most part, but we're seeing the same thing, which is both banks and insurance companies are pulling out of areas, coastal areas and things like that, or areas where there are a lot of fires. So what that is going to mean is that, you know, if you fast forward 10 or 15 years, there are going to be regions of the country where you can't get a mortgage, there won't be ATMs, there won't, you know, the banks won't have branches and things like that.
Right.
That's a possibility coming up down the road. It's not that the banks will stay there and keep making loans in the face of evidence of disaster, or that insurance companies will do right policies. They can cancel those policies every year.
Right.
So I think the risk is that they just won't be there and that people won't be able to get them. That's really the issue.
And it seems to me that that would be a massive source of instability in our economy overall if you were to see that kind of dramatic decline in home ownership, home values, not to mention the disruption that would occur if people literally couldn't be in their homes anymore.
So I think it's going to fall, if that happens, it'll fall on homeowners and
Right.
residents, but it'll also fall on state and local governments, you know, which you see happening now, where they're stepping in states where insurance is going away, private insurance. You're seeing states step in because they want those areas to remain prosperous. So I don't know that it's a financial stability issue, but it certainly will have significant economic consequences.
Well, certainly to try to figure out how to provide reinsurance as an example in the places where commercial insurance isn't available would be a massive impact on state budgets, if to follow your chain of thinking. And I know in this committee, I've heard some of my colleagues on both sides of the aisle talk about the challenges overall with flood insurance, just as an example, and the massive expense that would have for us as well. I raise this, colleagues, because I think that this is an important issue that we need to be paying attention to. I do think it has a fundamental impact on the overall health of our economy as we look not even down the road, but where we are right now. So I'm out of time. Thank you, Chair Powell. I have a question. You and I have talked quite frequently about my deep and keen interest in the Community Reinvestment Act, and I'll follow up with a question on that for the record.
Thank you. Thank you, Senator Smith. Senator Haggerty?
Thank you, Chairman Scott. Chairman Powell, it's good to see you here today. Welcome. I want to start by talking with you a bit about markets and inflation. Less than 6 months ago, you expressed some serious concerns about labor market weakness and the risk of persistent inflation. But since then, the FOMC has begun its easing cycle and cut its target rate by 100 basis points, as you mentioned in your opening remarks. Now, in the January meeting, the FOMC has telegraphed that it felt both the labor market and inflation have reached a point where you're comfortable maintaining its target range. And my question is this: the recent market data, including last week's strong jobs report, indicate that the economy is on firm ground. Indeed, swaps markets have begun to price in fewer and fewer cuts this year. And I just wanted to talk broadly about these market conditions that you see. Do you see evidence of a higher neutral rate emerging at this point?
Yes, I mean, let me say there was a lot of reason to be concerned about downside risk in the labor market toward the middle of this year, but really that concern has diminished significantly. Labor market's very strong. I think the evidence is, my own view, and there are many different views on this, but is that the neutral rate will have risen meaningfully. Very hard to be precise about it from what it was. It was clearly very, very low before the pandemic. Extraordinarily low, historically so, but yes, I think it's moved up, and many of my colleagues on the FOMC feel that way too.
It certainly seems that way. I'd like to turn now to what seems to be a very popular topic right at this point, and that's the CFPB. In your response to Senator Britt's question earlier, you confirmed that when the CFPB submits quarterly funding requests, the Fed is not in a position to exercise any discretion over what the funds are used for. Is that correct?
As long as it's compliant with the law.
it just strikes me that the Fed is not in a position to hold the CFPB accountable for what it does or how it spends its money. Congress hasn't been allowed to hold the CFPB accountable for what it does or how it spends its money. It looks like no one has been able to hold the CFPB accountable at all. And now I hear, complaints coming from every corner, particularly from the other side, complaints about the excessive delegation of authority to a Republican CFPB director when this entity was intentionally created to be wholly unresponsive to elected officials. So I just find that quite rich. Before I close, I'd like to come to a point on climate, and particularly the Fed's forays into climate activism that have taken place over these past 4 years and the recent retrenchment that we've seen. It's one thing for the Fed to disassociate from its past climate activism in a press release, but to credibly claim that it's divorced itself from partisan climate policies, the Fed needs to do more than just issue statements. It needs to actually end its climate policies. The Fed's independence from politics is a headline topic at the moment, of course, and while much attention has been given to potential external pressures on the Fed, I think it's also critical that we scrutinize how the Fed's own regulation and supervision might be utilized to in some way politicize the institution. So when the central bank strays from its mandate by embracing partisan climate policies, the Fed embroils itself in controversial political debates and invites legitimate political scrutiny. So I just want to urge the Fed to refocus entirely on its core statutory mandates. I know it's a commitment that both you and I share, Mr. Chairman. Thank you for being here with us today.
Thank you.
Thank you.
Thank you.
Senator Warnock. Thank you very much, Chairman Scott, and welcome again, Chairman Powell. I want to echo the words of Ranking Member Warren and so many of my colleagues today on DOGE and Project 2025's illegal attack on the Consumer Financial Protection Bureau. Certainly the Bureau was not created to be dismantled. And since its inception, the CFPB has been the only federal agency solely dedicated to protecting Americans' wallets and pocketbooks from scammers and predatory companies in financial services. The CFPB reduced costs for Americans, returning more than $21 billion to Americans who have been cheated since its inception. I want us to focus on that as folks are talking about chasing after waste and fraud and abuse. The CFPB has returned more than $21 billion to Americans. Make no mistake, this attack on the CFPB will increase costs for Americans, and it will give the green light to fraudsters and predatory actors seeking to cheat hardworking Americans. And so, Chairman Powell, thousands of Georgians of all political stripes have written into my office, and they are alarmed by an unelected billionaire and his hacksters' dangerous attempts to access Americans' private data and the Treasury Department's systems that control $6 trillion in annual payments to millions of American citizens, including Social Security, Medicare, and tax refunds. Quickly, yes or no, has Elon Musk or members of his team, to your knowledge, attempted to access the Fed's protected data and systems? Yes or no?
I don't
To your
believe so.
knowledge.
I don't believe so.
Okay, so will you commit to report to this committee, majority and minority, immediately should you become aware of any such attempt by Elon Musk or Doge to pierce the Fed's independence or to access its protected systems?
Yes.
Thank you for that commitment. The Fed's latest monetary policy report states that the tight labor market has allowed employment and earnings gaps between Black and Hispanic Americans and white Americans to narrow. I was glad to see that many of the long-standing disparities in employment and wages by sex, race, ethnicity, and education have narrowed under the Biden administration. Some gaps have reached historic lows. Specifically, the employment gap for Black workers and white workers is near its lowest point in almost 50 years. That is the economy that the Trump administration is inheriting, a historic low
in almost 50 years. Chair Powell, as you work to promote maximum employment, what steps will the Fed take to ensure that these equity gains are permanent?
So the best thing we can do it's both of our mandates really, because as you well know, high inflation hits people at the low end of the income spectrum first and most. And in addition to that, we know that the benefits of a strong labor market over time can be really visible and important in those communities as well. So we pursue our mandate, we keep our heads down, and it works out that is the single best thing we can do to foster, closing those gaps.
You pursue your mandate, you want to make sure that it's working. Would you agree that we still need good equity data to continue to narrow and close those gaps by race and gender?
I do think, we're always going to be in favor of good data at the Fed, and we do have quite a bit of that data on our website.
But if we don't have equity data, it'd be difficult to know, right?
Yes.
I'm glad to hear you still believe in the value of good equity data for economic policy making. It's better to fly with the data than to fly blind. I'm not sure what's so controversial about the data. And while I was disappointed to hear that the Federal Reserve, which is independent from the White House, had scrubbed a diversity and inclusion section from its website after President Trump's executive order, while also scrubbing data on the racial, ethnic, and gender makeup of its economists and researchers, I hope you will continue to ensure that the public has good data on how our economy is working or not working for historically marginalized Americans. I also hope you will reconsider your decisions around the whitewashing of the Fed's website. Chair Powell, as we think about the value of protecting data on the black-white wealth gap or employment gap, I think it's important to understand what policymakers can learn from this data. Historically, from what you've seen in the data, historically, what types of economic events have caused the black-white wealth gap or employment gap to widen?
Well, high inflation, downturns, you see generally just take the black unemployment rate, it generally moves at twice the speed of the white unemployment rate. So when it goes up faster, and when it comes down faster. But there is, at the end of the day, there's always been a gap, and we want to run a strong labor market, and we target overall overall labor market conditions for maximum employment. But one of the benefits of that is that gap comes down.
Thank you so much. We all know that fully deregulating our financial regulators like the CFPB, firing bank examiners at the FDIC, or weakening the Fed's supervisory capacity makes an economic shock or recession more likely. We know that this disproportionately impacts Black and Hispanic workers, and there are real consequences to weakening and eliminating financial regulations that keep us safe. Working people are the ones especially who suffer. So thank you so much, and I look forward to continuing to work with you to close these gaps.
Senator Banks is next.
Thank you, Mr. Chairman. Chair Powell, thank you for presenting your report to the committee today and for coming to meet with me last week in my office as well. The Federal Reserve has enormous power over Americans' ability to work and earn a living. And the Fed's interest rate decisions have an especially big impact on industries like manufacturing, which depend on big investments. Chair Powell, the Fed's data on manufacturing is still holding up nationally, but it doesn't look very good in the Chicago region, which includes most of my state in Indiana. The Beige Book says manufacturing jobs are declining and fewer people are buying manufactured products. It also says that steel demand is at a low level, auto production has slowed, and machinery orders are down. What does that say about the rest of the country? When manufacturing in the heartland slows, does that signal trouble for industries in other parts of the country?
It can. It doesn't always, but it certainly can. We watch the manufacturing sector. It's very important. Manufacturing jobs tend to be high productivity jobs. They're very important in our economy. But I would say over the last couple of years, manufacturing was pretty weak during years in which we had high GDP overall. Manufacturing is a smaller proportion of the economy than it used to be, but it's still extremely important.
Senator Reid asked you why free trade doesn't work when one of the giant players doesn't abide by the rules. The China shock is proof of that. The Fed has a mandate to maximize employment. How do you account for the whole industry that is repeatedly suffocated by unfair competition?
You know, we don't do trade policy. We're not responsible for it. We don't comment on those who do trade policy. So, but, you know, so we don't really have a role in focusing specifically on that. That really is left to those who have responsibility over trade.
Do you agree that a healthy manufacturing economy is important to a healthy overall U.S. economy, though?
I do.
I hope you had an opportunity to read Robert Lighthizer February 6th essay in the New York Times. He explains why a big trade imbalance between any two countries is harmful to citizens in both of those countries. How does the Fed take the trade deficit into account in your decision-making at all?
Again, we really don't. You know, we're aware of it, but it's not something that directly affects our mandate goals.
So not at all?
No. I did read his book, by the way. I didn't read that editorial.
Fair enough. It is a good book as well. I want to get into tariffs. It's no secret that most conventional economists hate tariffs. But I want to note that Indiana gained manufacturing jobs during President Trump's first term with the 2018-2019 tariffs. Even though the economist's conventional wisdom is that tariffs will reduce jobs, do you commit to following the data and not prejudge any outcome?
Very much so, as we did in 2018-19.
Finally, my staff reviewed the research paper on tariffs in preparation for this hearing, and I want to point out one of them called The Employment Consequences of U.S. Trade Wars. Mr. Chairman, I'd like to enter this paper for the record. It found that the timing of tariffs are very important. It found that China's retaliation to President Trump's tariffs did hurt U.S. jobs, but if the U.S. had imposed tariffs on China much earlier in the 90s and early 2000s, it would have almost completely eliminated job losses due to the China shock. And I know you've said what you said before, but will you and your staff please take a look at this paper?
We certainly will. I imagine we already have, but I'd love to see it.
I appreciate that. Home ownership is an essential part of the American dream, but families are struggling to afford homes. In just 5 years, the price of a typical home in Indiana has gone up more than 60%. More than 3/4 of American families can't afford an average home in their neighborhood. How do the Fed decisions about monetary policy affect the ability of regular families to buy a home?
Most of what will have driven that increase will be about, some of it's about local regulation, as you, I'm sure, know. It's also about just wages going up and costs of materials and things like that going up. And land costs and all that are going up a lot. The channel that through which we affect housing is, of course, interest rates. And right now, interest rates are still pretty high, but actually, mortgage rates are really not set at the Fed. Those are really key off of longer run things. Nonetheless, we're clearly having an effect on the housing market, and that'll unwind as we normalize policy. But we're still going to be faced with high insurance costs and high material costs and labor shortages and all the things that keep driving housing prices up across the country.
Thank you. My time has expired.
Next will be Senator Gallego.
Thank you, Mr. Chair. Mr. Powell, just kind of running along that vein of thought, the housing costs are one of the top concerns of my constituents in Arizona. From 2010 to 2022, rents in Arizona increased by 72%, and I wish wages were as increased to match, but they did not. And the average 30-year fixed mortgage rate has been above 6% for nearly 30 months. With very few rate cuts anticipated in the near future, potential cost increase from tariffs or imported construction materials, as well as the demand that we're going to see in terms of rebuilding from California and labor shortages. What do you think needs to happen to make housing more affordable in Arizona and the United States in general?
You know, housing policy and things to help housing supply are really in your wheelhouse, not ours. I do think you know, the housing markets around the country are still suffering from the after effects of the pandemic. Once that's all the way through and short-term rates are down to normal, whatever the new normal level is, I think housing costs are still going to be high. I think it's still going to be expensive to build housing in many parts of the country where lots of the urban areas, the obvious places to build housing has happened. So I think it's a long-term. There's a short-term problem which will go away in coming years. But there's a longer-term problem with housing availability, and that's going to be something that's not within our authorities or power to affect.
You know, one of the things that I've seen in Arizona is because we have people that are locked into mortgages at 2.9, 2.8%. And in order for them to move to the new house, they're going to have to essentially go and try to get, quote unquote, a bigger house, but the mortgage payment is going to be through the roof. And while I know the Fed doesn't set the mortgage rate, at the same time, one of the biggest drivers, obviously, of inflation, especially in places like Arizona, is housing costs. And then one of the biggest decisions essentially you make on whether or not to move rates is inflation, which is driven by housing costs. So we're in this kind of perpetual vicious circle in Arizona when it comes to interest rates. So I don't know what the answer to that is, but I just want to say at least for there to be some understanding on that, because it's the reason we're not breaking out of this cycle is because the problem kind of feeds itself over and over and over again.
Yes, that's exactly what's going on. But it's not obvious, though, that lower rates would lead to lower housing inflation because, of course, that would increase housing demand. It would unlock people's, low mortgages, but that creates both a buyer and a seller. So it's not clear that would be something that would drive down housing inflation.
Well, my supposition, especially in places like Arizona, which is really growing fast, is that by increasing supply with lower rates, you end up essentially having more of a competitive market, so people will start moving and essentially bring down the overall cost. But moving on, so I've also heard from businesses in Arizona, they're concerned about the threat of economic stability in tariffs that are imposed on our key U.S. trade partners. How should we expect prices to move for basic items like tomatoes, peppers, cars, and the like if we place a 25% tariff on Mexico next month, as the president has threatened?
So as you know, we don't do tariff policy and we don't do commentary on tariff policy. Just generally, when somebody's got to pay the tariff, and it can be the exporter, it can be the importer, it can be a middleman, and it can be the consumer.
For it, though.
Somebody does, but in some cases it doesn't reach the consumer much. In some cases it does, and it really does depend on facts that we haven't seen yet.
But that also contributes to some of the calculations on inflation overall.
It can, but
it's hard to predict.
There's a question of how persistent that would be and how large it would be.
Mm-hmm. So, and of course, I understand you're not here to specifically comment on trade policy, but overall, is it your opinion, let's just say a base opinion, that high tariffs can lead to higher costs, which would then end up being seen in terms of your inflation calculation that helps you set the rates?
So I'd say that's a possible outcome, which will depend very much on specific facts about what's being tariffed for how long, et cetera.
Okay, thank you. I yield back.
Senator McCormick.
Thank you, Chairman Scott, and Chairman Powell, good to see you again. In the past 5 years alone, the national debt has exploded. Federal spending and the debt have increased by more than 50%. Debt held by the public, or true debt obligation, has more than tripled during the past 15 years, reaching more than $28 trillion. All told, U.S. national debt is now over 120% of our GDP. And runaway spending contributed to a regressive tax on all Americans, a tax known as inflation. In the past 5 years, the cost of living has skyrocketed for working-class Pennsylvanians, especially, as you and I discussed when we visited, those relying on fixed incomes. And unfortunately, that compounded effect of inflation has not been offset by commensurate rise in wages for many Pennsylvanians. I've heard from countless Pennsylvanians who had to count their dollars at the gas pump, cancel family trips, even tighten their belts at the dinner table because of inflation. So while we discuss these heady issues, let's not lose sight of the very real human cost of the decisions made by people sitting in this room. And given that cost, I'd like to ask you about the national debt and the cost of financing it. We now spend more to service the debt annually than we do on national defense. So how concerned are you about the accelerating pace of government borrowing and the borrowing cost, which will affect families in the form of higher mortgage rates?
Yeah, we don't comment on fiscal policy other than to say that, as my predecessors have said, that the U.S. federal budget is on an unsustainable path. It's not that the level of spending or the level of the debt itself is unsustainable. It's that the path is unsustainable, and ultimately the level of the debt will be. So there's no time like the present to start working on this. The longer we wait, the more painful it will be. It's something we need to do and will have to do in the long run, and the short run is better than the long run for that.
And just as a practical matter, how do you factor that into your policy thinking and decisions?
We don't. You know, we're here to achieve maximum employment and price stability, and it's really up to Congress to deal with fiscal issues, and we leave that to you.
Well, just as a more practical question, I think which falls clearly in your bailiwick, because of that national debt, it's caused the supply of U.S. Treasuries needed to finance the debt to skyrocket. And that's at the same time the Fed is shrinking its holdings of Treasury through quantitative tightening. So the question is, or could you at least give us some insight into the impact that this is having on the Treasury market as investors must absorb that supply? And in particular, I'm interested in how the biggest holders of U.S. Treasuries, how their behavior is changing as debt increases.
So this is a real Treasury question, but I think from our standpoint, I can say that there are lots of buyers for Treasuries, but Treasury buyers are going to be factoring in their assessments of the supply that's coming, and that may be part of the reason why the term premium has increased, as you know, over the course of this year. Although, you know, the rates have been going up and down lately. They're almost back to where they were before the election.
I know the Fed has been moving forward with comprehensive changes to the stress test process. Could you discuss how you're thinking about reducing the volatility of the results and increasing transparency on the stress test?
So on transparency, we're going to release the models, clean them up and publish the models, put them out for comment. In terms of volatility, we're also going to release the stress test scenarios before we implement them. In terms of volatility, what we said we would do is average the changes to, the problem is the stress capital buffer can be moving up and down just because of volatility in the results, and it seemed like a good idea to smooth that out by averaging over a couple of years. We're putting all this out for comment, though, and ultimately we'll reflect those comments in the final decisions we make.
Thank you. I'll yield back my time.
Thank you, Senator McCormick. Senator Blunt Rochester.
Thank you, Chair and Ranking Member, and thank you, Chairman Powell. It's good to see you, and thank you for meeting with me last week. We discussed everything from jobs and housing supply to the real impact on Fed policies on all of our lives. And I also got a chance to share with you just the concerns and consternation of Delawareans who, for the past few weeks, have been frightened by firings and funding freezes, and just the real impact on people's financial and personal data and information when, DOGE has access to this information. I'm hearing from my constituents as well about the potential shuttering of the Consumer Financial Protection Bureau. As Senator Warnock mentioned, CFPB has returned over $21 billion to millions of consumers, and that's a real impact. But I want to also highlight that it was your leadership in the Fed working with Congress and the Biden administration to really help answer that question that you were asked about if you had the choice to switch countries with France and Germany and others, that you said no, you'd rather be here. And that success is a testament to all of us. We came together during a really tough economic time at the end of this, during a pandemic, and it limited the recession and job losses. And since COVID, we've seen a robust job growth. But we also have grappled with inflation that drove prices up for so many goods. And I've worked to address one part of this phenomenon, our supply chain disruptions. In fact, I recently joined Senators Cantwell and Blackburn to reintroduce the bipartisan Promoting Resilient Supply Chains Act to address supply chain vulnerabilities. And while we see indications that inflation may be slowing, too many of our constituents are still facing high prices and economic uncertainty. We need to do everything that we can to address this anxiety and the realities that Americans are facing. And there seems to be a disconnect. While the economy is doing, well here, on the ground, people aren't really feeling that. So, Mr. Powell, can you talk about, from your perspective, just what is driving this disconnect between traditional economic indicators, such as GDP growth and the stock market performance, and the tangible benefits for families?
I'd be glad to. So it is clear that the overall aggregate numbers are just very, very good for the economy. 4% unemployment, inflation down to 2.6% last year, and the economy growing well in excess of 2%. These are good numbers. But what people are feeling is the results of several years of inflation, and particularly for people in the low and moderate income category, they're really feeling it. So if you look at the earnings releases and press conferences that they do, that companies like the dollar stores and things like that do, who deal a lot with low and moderate income people, they're all telling you that those consumers are feeling really strapped. So we do understand that, and we try to keep that in mind. Even though we acknowledge that the overall data are good, we see what people are feeling, and that's inflation. So it's just another reminder how much people hate inflation and how bad inflation is for people, high inflation, and it just furthers our resolve to get inflation back to 2% and keep it there.
Thank you. One of the big areas that I focus on, you've heard many of us across the aisle talk about the housing crisis that we have in this country. And I know a few others have asked questions previous to me about this, but I would love to follow up afterwards with specifically what you think are the short-term and long-term things that we can do to really address the housing supply and affordability crisis. I have legislation that looks at things like reducing regulatory barriers, zoning reform, these things that we know we can, in partnership with local governments, make a significant difference. And so if I could, would love, again, to follow up with you, even cutting red tape, those kinds of things that we can do long-term and short-term. But I did want to mention one last thing in the 20 seconds that I have. The Fed listens, things that you do, activities that you do. Could you talk a little bit about that as well? Because working people, a lot of times people don't feel that they have a place in these kind of conversations, but can you talk about what the Fed does with Fed listens?
So briefly, we did this as part of our review 5 years ago, and we do it on an ongoing basis now. And the idea is that we break out from the usual people that we talk to, which is a pretty diverse group, and try to deal directly with people who are experiencing the economy and our policies. And it's quite eye-opening to listen to people talk about it. We had one person at the Chicago conference 5 years ago who said the expansion, which was then 9 years old, is just reaching my community. And he talked for some minutes about how companies were going into prisons and finding people who weren't going to get out for a year or two and training them and stuff like that. You could hear a pin drop. It was very telling stuff. So I think we learned from all that. And so we'll keep doing it.
Well, I will end by saying there's a famous quote, I think it's Martin Luther King, we may have come over on different ships, but we're all in the same boat now. We need to get it together. Thank you. I yield back.
Thank you, Senator Blunt Rochester. Senator Marino.
Chairman, thank you for being here. Thank you for taking the time on the phone the other day. Appreciate that very much. Just to ask you a broad general question. When you increase M2, the money supply, by 40% over a short period of time, is that going to drive inflation?
It could. Well, as I think we discussed, monetary aggregates have not been a great predictor of really any other thing. But I think when there's a sharp increase like that in M2, then that could, that's something that might cause some inflation.
Now, is that just to be clear for the people watching, that happened because of public policy in this institution here, correct? In other words, there wasn't a civilian-led effort to increase government spending outside of the elected leaders that chose to make those decisions.
I think that was part of it. I think there were just a lot of causes in the inflation that we saw, but that, it's fiscal policy, it was monetary policy, it was just closing and reopening the economy, just generated a bunch of confusing signals and then a lot of inflation everywhere in the world, really, whether people did a lot of fiscal policy or not. So, but there were many factors, and that's, I would say, one of them.
But just to be clear, it wasn't the citizens of the country making those decisions. Those were elected leaders choosing to close the economy. Businesses didn't decide one day to close, didn't decide to not be able to go to work. Those were decisions made by policymakers, correct?
Yes.
So it's a little disingenuous to be hear my colleagues talk about how they care so much about inflation when in reality they cause it. But I don't want to continue that. I'd ask you a question just out of curiosity, because you worked at the Department of Treasury. At what point did you think they were going to run out of ink? Did that concern you, that maybe it was possible that they were printing so much money that the Treasury would have to find alternate ink suppliers?
Didn't occur to me, but good question.
So along those lines, something that concerns me a lot is the idea that we would even look like China in any way. So can I have your commitment that as long as you're the chairman of the Federal Reserve System, that we will never have a central bank digital currency?
Yes.
Thank you for that. I think that's extremely important. It makes me very happy to hear you say that. Shifting gears to a little bit something that matters to me and entrepreneurs all over the country is, why can't I wire somebody money at 6 p.m. Eastern time? Can we get to a 24/7 scenario where wires are cleared every day, all day? I think that would be very, very helpful to businesses all over the country.
So that's coming. It's just coming slowly here. We have that at FedNow. We'll get in touch with you about FedNow. We provide that service between two banks, and others want to provide it too. But yes, we do kind of lag a lot of other countries in that, and it is time for that to happen.
So I know I don't want to put you on the spot, but to put you on the spot, FedNow was very familiar with it, but it was a little bit late in coming. Can we get a commitment to do that this year, so that by the end of this calendar year, businesses can transact 24/7 and settle payments?
Well, I think they can do that now I believe they can do it now on FedNow, and they can also do it on the RTP system as well. So I think it's available. Let me check in and I'll follow up with you.
That'd be great. One other piece of the puzzle here is, what do you think the Fed can do to fight international terror groups, for example, Hamas, Hezbollah, Iran, the proxies that are funded by places like Qatar? Do you think that we're doing enough to keep them outside of the banking system? Because at the end of the day, terrorism is ultimately funded by these bad actors. I met with the hostage families this morning. It was heart-wrenching to hear stories about kids that are my kids' age being held for almost 500 days. The Qataris are obviously completely complicit in all this. What can we do? What advice would you have that we can do to make certain that we bring these terror groups to their knees?
You know, we do enforce the money laundering laws very, very strictly, and but it's a tough question. You know, it's a huge focus in international meetings and things like that. But you're right; it's really hard to nail it down, particularly if it's all happening overseas. But we can do what we can do with our banks. We don't want to make it so costly, though, that they debank people because they're so worried about violating the money laundering laws. I mean, that's some of what's happening, according to the banks, is that they're so afraid that there might be money laundering that they just cut people off at the first flag, as opposed to perfectly legal businesses are being, thrown out because of their fear of being caught doing money laundering. So I think there's a balance there, but no, it's a really, really hard project and one we spend a lot of time on.
Thank you, Chairman.
Thank you, Senator Marino. The patient and persistent Senator Kim.
Thank you. I wanted to make sure some of my colleagues had a chance to be able to run off to some of their meetings, and I've enjoyed being able to listen to the chairman, to be able to hear some of your articulation here. I just want to share with you, I did a telephone town hall last night, and I'm glad to hear some of my other colleagues as well. And there is a lot of anxiety right now by the American people in trying to understand what's happening and seeing and interpreting what's happening on the news. I guess I just wanted to ask you, if you were for your words of how you would explain to the American people the importance of independence when it comes to the Federal Reserve.
So I think the point is that we'll make better policy, we'll keep inflation lower if we just focus on doing our job and stay out of politics, stay out of elections, don't try to favor or to hurt any political party, any political figure, just focus on the data. If we start putting up political filters, we'll be no good, we'll be less effective at our already quite difficult job. And I do think that's broadly understood. I think there's broad support up here in both political parties and on both sides of the Hill. I think that there is a decent degree of support for continued independence. That's not to say we shouldn't be accountable. We should be very accountable and transparent about what we do. We should be up here explaining what we do and why to our oversight body, which is this committee and then the same committee on the House side. So that's what I would say.
Making decisions about your core mission about stability and about growth, but not thinking about it in terms of the context of an election cycle, for instance. Is that right?
Yes, exactly.
I wanted to just shift gears a little bit, but similar type topic. There's been a lot of attention to the role of public servants within our government and, our understanding what roles they play, how many to have. And I guess I just wanted to ask if you could speak to the role of the Federal Reserve employees, their qualifications, and more importantly, like their importance to the mission and being able to engage. How important are they to the work that you are trying to do towards stability and growth?
So I'm very proud to be associated with the people of the Federal Reserve, and I'll give you an example why. When the pandemic hit, kind of out of the blue, and economies all over the world are shutting down, the U.S. Treasury market is stopping to function, companies can't roll over their commercial paper, economists are writing about a depression. People at the Fed who went through the global financial crisis 10 years before step forward and say, we got this, we know what to do. Here's what we do with the Treasury market, here's what we do with money market funds, here's what we do with the companies that can't get any financing. The markets were closed and companies were having maturing debt that they had to roll over. The people who knew what to do in that pretty dire emergency were working at the Federal Reserve and other places. But I will tell you, it was impressive. And I think if you could have seen the way people react and how hard they work and how much they know and how well it worked, really. Our work during the acute phase of the crisis was very successful, and it's entirely due to the knowledge base that resides with career people at the Fed.
Yeah. Would you say that the Fed is overstaffed?
No, I would say that, overworked, maybe not overstaffed. Everybody at the Fed works really hard. It's a place where people work.
And a lot of this conversation right now about staffing numbers at different departments and agencies, it's going back to this sense of the taxpayer dollar, in terms of accountability there. But I guess I just wanted to ask you, is the Fed paid for by the taxpayer dollars? Can you explain to us what the burden is on the taxpayer?
So we're self-funding through our large balance sheet.
So when it comes to the staffing at the Federal Reserve, not coming from the taxpayers, is that right?
Indirectly, we give away all of our profits we give back to Treasury, and those profits would be higher if we didn't pay for the Fed. So in fairness, it's ultimately paid for by the taxpayer. But in that sense, we're self-funded.
Self-funded.
Yeah.
Just one last question here. You talked about the different actors that are involved when it comes to levying tariffs in terms of paying that the exporter, the importer, the consumer. You said middlemen could be part of that. I guess I just wanted to ask you, do you know of any way in which to 100% guarantee that the consumers will not have to pay higher costs when it comes to tariffs?
Not really. It's not going to be easy to identify with any accuracy exactly where costs do fall, but I think it'd be hard to guarantee any particular outcome. I think we're just going to have to see.
Great, thank you. I yield back.
Thank you, Senator. Senator Warren, did you?
I do. Thank you, Mr. Chairman. I just want to make a point before we quit here, and that is about law enforcement. If you keep the laws the same on the books, but you fire the cops, you're going to have a lot more crime. That's kind of law enforcement 101. And the problem we've got right now is law in the books about consumer protection hasn't changed. But the cops, at least right at this moment, have been told at CFPB to stand down. And I appreciate that we have state AGs who step in, and often they partner up with the CFPB. But there is no one else for the giant banks who actually does what's called the bank examination, the supervision. And that is so important. Remember the Wells Fargo scandal, where Wells Fargo was illegally opening fake accounts in people's names? You find that through bank examination, not because the person who got cheated could figure it out. Bank of America gets hauled in because bank examiners discovered they were charging people illegally on junk fees. Nobody finds that but the people who are down in the banks doing the bank examination on behalf of the consumers. Look, we tried a patchwork of law enforcement for consumers before 2008. We had all those laws scattered among 7 different agencies, and we saw how it ended. It ended with millions of people losing their homes, millions of people losing their jobs, millions of people losing their savings. The CFPB is our law enforcement agency to make sure that the giant banks follow the rules on consumer protection. And for me, right now, I'd be really worried about doing business with a giant bank when there's no cop on the beat.
Thank you, Senator. I will recognize myself for just one question, and it'll even be relevant to your job, I promise, Mr. Chairman. So thank you for your patience and for being here. I wanted to follow up on there were some questions, or at least I know Senator Rounds asked a Basel III question, and your response was basically, let's get the people in place from the administration, and then we'll proceed again. Treasury Secretary Besson recently said that the banking system is, I believe, said, quote, well-capitalized, perhaps over-capitalized, unquote. And given that assessment, or if you agree with it, could you discuss the necessity of advancing a new Basel III proposal, specifically how an updated regulation would impact the ability of the regional banks to compete with the big Wall Street banks, and what considerations should be taken into account to ensure that we have a competitive banking system? Because I know there's this concern comes and goes, and for those of us who have largely regional banks, or God love them, the best of all, community banks and credit unions, a competitive system is really important. So if you could just answer that, and then I'll wrap up.
Sure. So we're eager to get together with new colleagues from the FDIC, new leadership at the FDIC and the OCC, to try to finish Basel III. My own view has been that our banks are well capitalized, and Basel III was not supposed to be an exercise in raising capital in U.S. banks. Mario Draghi said that. Dan Tarullo said that back in the day, I believe. So I think that's about right. We have some work to do, but we'll get there, I believe, fairly quickly. In terms of your regionals, they don't face the GSIB surcharges. They don't face quite the burden that the large banks face on resolution planning and that sort of thing. So we certainly need those banks to be healthy and profitable, because we need them to compete with the GSIBs. We don't want a world where the GSIBs just keep getting a bigger and bigger share of the economy. That's not what we're looking for, and that's what a lot of pressure. We've seen the number of community banks, especially, declining for 30 years.
Yes.
And this is not something we want to. We don't want to be the cause of that. If it's happening by natural causes or because of evolving technology, that's one thing. But we don't want to be inadvertently causing that to happen.
So as you look at a Basel III exercise, can you think of anything specifically that ensures that competitive, diverse banking system is maintained rather than a consolidation, whether it's fewer community banks into more regional banks, or fewer regional banks into more Wall Street banks?
Well, I just think you think twice before you impose the kinds of things that we impose on the largest banks and the next to largest banks. You want to be careful not to just think we should do exactly the same thing. It's what tends to happen is, so for smaller banks, it raises the fixed costs, is what it does, of banking, and it makes it harder to start new banks, and makes it harder for any but the largest to be successful. So That's not what we want. You know, we want a lot of competition, and, you know, these regionals, it's important that they thrive.
I agree, and I agree with your assessment. So thank you for that. Thank you for staying with us for the day, and glad we could get you first. So as we wrap up, for senators who wish to submit questions for the hearing record, those questions are due 1 week from today, Tuesday, February 18th. Chair Powell, you have 45 days from that day to submit your response to questions for the record. Thank you. The committee stands adjourned.
Thank you.
All right, folks. So the event has concluded, as we can see. A lot of fun watching that testimony and learning just disappointingly how little a lot of our representatives seem to understand about how the Fed actually operates as an entity, how they're funded, what their role is, that Powell is there as the chair of the Fed and not their consultant or advisor to try to tell them how to run fiscal policy or advise them about ethical issues or otherwise. I mean, every hearing is an eye-opener about just how important and lacking education and economics, monetary and fiscal policy, and just overall money is within our legislature. The legislature that represents the most wealthy country on earth, arguably the most powerful country on earth, yet has very little competence in some of these key areas, which, I mean, it is quite frankly a little bit alarming. I'm not gonna, I'm not gonna kind of try to hold back punches here. I feel like a lot of these folks are recklessly negligent and incompetent in their core duties if they're sitting on financial committees or otherwise, and their obligation is to understand and be aware about how this really crucial subject matter affects our country, and they're not capable of doing it. And very few overall seem to be capable of doing it within the legislature in either party, by the way. This isn't a partisan issue. That's a concern, and it kind of explains a lot of the reasons why maybe we're in a bit of trouble as a country, why we've run into so many different kinds of trouble, and also why there's probably so much corruption in various parts of the government. But at the end of the day, what I got from this hearing was more of the same. Basically, Powell's talking about the neutral rate being higher than what it was during COVID. The market didn't really like that too much. So he came back down to the second most active put strike and the gamma 2 level. I'm going to just pop a chart on screen. So give me a moment while I do that. And then what I'm explaining will make a little bit more sense because you'll have that visual. So I'm just going to drag that over here. So this is a stream from the Trader Aid Discord, and you can see how well some of the ways that my code maps levels could really help you manage risk. Just for one, like you could see the lows today were well defined by one of our pivot levels that was visible before we hit there, so you could manage that risk pretty well. You could see the secondary lows managed by that hot put, and then those resistance levels overhead. One of the pivots, we saw interaction there earlier, validating that. The gamma 2 level, which eventually became the second most active put strike, we could see all that interaction there, how important that was. And then moving above that gamma flip also had some interaction with it, making a big push above the 6079 pivot. You can see once we punched above it, that was a big area for price interaction. We ultimately resolved at what became the warm call and what was before that the 6090.75 pivot, right? So that was sort of like our full move. I thought maybe we could get to the hot call since we have so much activity there, but market had other thoughts and it broadcasted that to us when we failed the 6090.75 pivot and then started to roll over. Another important area is this big green line. That's the 21 period moving average. And this is a 5-minute chart. So that just gives you a sense as to how that's calibrated. That's the big green line. So that's a momentum indicator. It's a bit of a lagging indicator, but it gives you a sense that when momentum broke to the downside, We also saw continuation, right? Right down to the second most active put strike and the gamma 2 level, which is converted to ES. So all in all, when you combine options flow and positioning with the pivot levels that are based on market generated information, you have better definition as to where price action may go, where some of these key levels are that you can use to manage risk and reward. And this is pretty helpful. So you can see with this low, we made a very similar low as earlier, right around that second most active put strike and the second largest level of gamma exposure on the SPX chain. Also made some updates to the SPX options visualizer. So now we're displaying 10 gamma levels, 10 key levels, in addition to the other market generated information that comes onto this stream. So again, this is on the TraderAid Discord, as is our overnight bookmap stream, some of the other pivot streams for swing traders as well, not just for day traders who got information for longer time frames. Lots of cool stuff that we're working on and continue to build out. So for now, if you're trading this, I'd say we've seen an interim low put in, right? We're seeing buyers finally step up. This is the first big buy candle we've seen in a couple of hours, right? This is pretty much the first big buy candle, maybe 90 minutes or so, but still, it's the first big buy candle we've seen. Buyers are actually kind of coming back from that strike, because we had 1, 2, 3, 4, 5, 6, 30 minutes of 5-minute candles just selling straight up, even right below the big green line showing momentum favored sellers. You could see some continuation on that. Now we're seeing some resistance overhead at the 60.79 pivot again. If we're able to break that and the BGL, I think we can get right back up to 60.90. But whether we can get continuation to that hot call strike, that's going to have a lot more to do with whether we're able to push above that pivot more meaningfully. Last time we could see the warm call and that pivot acted together as a confluence area of resistance. So we're looking to see whether A, we're essentially making a low and reversing here, which so far the low seems to be in, the reversal's up to breaking above that 60.79 pivot and building some acceptance, and then whether or not that allows us to get that push up to 60.90.75. So we're seeing that push now above the 60.79 pivot. And it's going to be a matter as to whether we can complete that move and get to 60.90 and then how we behave up there. If we're able to build above that 60.90.75 pivot, I think this time we'll probably get to that hot call. One thing that's certain, the call flow is definitely much more significant than the put flow today, especially that hot call strike, right? That hot call strike in isolation is it's almost as big as the warm put and the hot put together, minus maybe 10K contracts. But that gives you a sense there's still a lot of interest in higher prices in this market. So then if we change view here, we go back to bookmap, because I do like to use motive wave and bookmap a bit interchangeably. You can also see there's this interest at the 6100 strike. So if we layer on the SPX options visualizer here into the bookmap stream, so I'll go to my filtered stream. Again, this is also on the Discord, so you can see this when you're a TraderAid member. Here's the filtered stream. This adds those SPX options levels that we were viewing in motive wave on to bookmap, and you can see there's these convergences, right? You're seeing more bids. You're seeing more offers building overhead. And there's one offer of particular interest to me that I talked about a little earlier, the 6100, 285 on offer. That's right there near the hot call. That's another confluence showing there's more interest building overhead. So overall, this flow favors us getting back to that point of control and then testing that next pivot just around the warm call and making a push higher. So we're going to go back to the motive wave chart just so we can kind of go from one to the other. So here we are, we've pushed above the 60.79 pivot, we're pushing above the big green line, and this is the second 5-minute candle where buyers are showing some strength, right? So overall, it looks like that reversal's in. We talked about the bottom being around that warm put and gamma 2 level being confirmed. Now we've confirmed the reversal with this push above 60.79 and the big green line. So overall, it looks pretty constructive with the flow and where price is moving in relation to both options positioning and some of these pivot levels. So I would look for this continuing up to 60, 90, 75 on this move. We're getting the third 5-minute candle in a row. It does look like we have some room for this push
And
to
Trump
continue
says,
here.
with the US in charge of the land, you can have civility in the Mideast. And Trump says, I believe 99% that we'll be able to work out something with Egypt too. And Trump says we will run Gaza very properly. We're not going to buy it.
I didn't realize it was for sale.
Trump says, I do not think Hamas will make the Saturday deadline for hostage release.
In terms of Yelp, YELP, no circulations. Any long idea from Zax for Yelp?
ECB Schnabel says uncertainty in trade has risen dramatically. So ECB Schnabel commenting in a speech in Germany.
We're seeing that buying momentum slowing down just a little bit on S&P futures off that bounce on the gamma 2 level. We are flipping back into positive gamma just by a little bit, by about, let's call it 8 points here. You can see that volume trailing off as well, just sort of at the lower end of the chart on the motive wave stream.
Trump says Hamas must have all hostages out by Saturday or all bets are off.
Continuing to see call flow grow in the two most active call strikes, the hot and long strikes. About 74,000 in total between the two versus the two most active puts at about 57,000. So flows still do favor upside from here. Some interesting earnings coming up after the bell later. Supermicro, Upstart, DoorDash, Lyft, Freshworks, Confluent, Zillow. I'll be interested to see how some of these mid-cap growth companies are doing. Seeing some pretty big sweeps coming into XLE today. The energy ETF targeting $94. It's about $700,000 worth of premium paid for those 94 strikes expiring Feb 28. And these were aggressive. These were both significant amounts of volume versus open interest on both of these trades.
Trump says we're going to take Gaza.
That's going to help the market's mood. So I don't like hearing that geopolitical escalation. Every time we get this sort of talk, it generally sees a little bit of de-risking. So we'll see if that has the same. But generally when Trump is talking about, kind of what's going to happen with Gaza or tariffs or otherwise, we get a little bit more volatility in the tape.
So EU's privacy watchdog says China's DeepSeek may face further regulatory actions in the future.
Seeing some pretty chunky flows coming into double AOI as well, targeting the 30 strike.
Jordan's King says Arabs will come to the United States with a response to Trump's Gaza plan.
That's expiring March 21st. It's $912,000 in premium paid for those double AOI calls. This has been a big squeeze that's been settling. So this stock moved from like
Trump, when asked if he
to
planned to do
44.
development personally in Gaza, says no.
Also seeing some pretty big flows into gold miners. GDX earlier today. 440.
Trump, when asked what authority would the US take Gaza, says under US authority.
Sure, we're still wave a wand and we have the authority to do all sorts of things. GDX, about, just about 440,000 coming into those in calls earlier today, targeting
Trump, when asked
$47.50.
when Gaza is, Trump says when Gaza is developed, which will be quite a while from now, it will bring many jobs to the region.
So Trump speak again, not really great for this market. You can see that pressure coming in onto ES, re-challenging that 60.79 pivot from above, falling below the BGL. So both of our little tools to track the price action here. Momentum now flipping to favor sellers, and that 60.79 pivot, if it gives way, we're likely to get back to that prior low, that warm put gamma 2 convergence level. Let's flip views here for a second. I'm just going to look at Bookmap. So we can see there's also a reasonable amount of offered liquidity overhead that's providing some resistance, basically giving you the sense that buyers don't have the demand to push higher. And that level of offered liquidity is right around where sellers have previously been quite aggressive. You can see that in the session volume profile, that aggressive sell delta at 26.75. So there was some resistance there that largely came online when those Trump headlines were starting to come through, that he's saying, we're basically going to take over Gaza on imagined unilateral authority. Tesla continuing to fall. If you were on the stream earlier and I was doing my Back to the Future stream, that was one of the stocks we looked at. And I looked at it the other day, I think when someone requested a chart as well, but basically I just see more downside, probably getting back to the 200-day on Tesla. The stock often trades inverse to its fundamentals, but Icarus can sometimes fly too close to the sun as well. Pretty aggressive call sweep in Soundhound earlier, which is interesting. The stock is trading down about 6.34%. We saw a sweep of 340,000 in premium targeting the 27 strike for April 17th. So that would be basically trying to play their earnings, I guess, without paying too much for the vol. And you'll recall from navigating the markets last week, we talked about XLE being a potential candidate. We were looking for a break above the 50. We did get that yesterday. We're getting that continuation today above the 200. So XLE actually setting up pretty nicely here. Let's just bring up a separate chart. So we can look at it on TrendSpider here. And this is a monthly view, so you can see on that monthly view lots of consolidation up here. If we can build a bit more momentum, if we can kind of break above those old highs, I think we get a very large move. But if we zoom in here, this sort of daily chart, this intermediate term time frame, looks a lot more constructive. It looks like we've put in a higher low. It looks like we've broken above the point of control here. Buyers really starting to put in some more work on XLE. So we still have a little bit more work to do. I'd like to see it break above the value area high more decisively, start to build some acceptance up there. But I do think that this one has some potential momentum, especially with some of the geopolitical tensions heating up again in the Middle East. That is a new catalyst for oil that may end up having more staying power the more that we have this discussion of, oh, we're just going to sort of take over Gaza. That's going to spark up a lot of tensions in that part of the world. So we can see overhead, still have that implied offer on Bookmap, hundreds of contracts, not quite a death cloud, but enough to warrant attention. So let's see if buyers try to make another run, if they're able to chew through that supply. If they are, then it looks quite constructive, right? We're still looking for a break above that aggressive sell delta that we had earlier as well, which is just below the point of control. So really a push above the point of control would address both those concerns. Switch back to our view of the pivots again. That gamma 2 level really helping to define the low so far, and we're holding above the 6079 pivot, still below BGL, so momentum is pretty much neutral right now. Sellers do have an opportunity. They could make a push back to those session lows, but they really need to act on that sooner than later. It's also a sleepy lunch hour for the next 15 minutes or so.
Fed bids for 3-year notes total $15.9 billion.
We do have that 3-year note auction coming up at about 1 p.m. It's going to be $58 billion on offer. Tomorrow we have a 10-year note auction after CPI data as well. There'll be $42 billion on offer, and then $25 billion after PPI on Thursday for the 30-year issuance. So lots of Treasury issuance this week. Pretty busy week with different moving parts. We may see some of that just-in-time hedging flow this PM session ahead of tomorrow's CPI reading as well. And what that looks like is more puts sweeping through SPX at some of these lower strikes, some of these big even numbers. In the last half hour of trading, you see more just-in-time hedging because there's so much vol selling. There's no reason to have your hedges on any longer than you have to have them on. Sort of change some of the ways that folks are hedging.
Chasing your shadow, but I will never know where we'll end up. I will follow where we go.
And we are starting to just sort of get a look here that there's not really much decisiveness. The last 3 5-minute candles, the current one included in that, just kind of dancing around the 6079 pivot. You can also see volume levels on the bottom of the chart really dropping off after the making of that low, that decline, and then the reversing off that low. Now we're just sort of back to the doldrums. Ahead of Upstart's earnings tonight, seeing some interesting sweeps earlier today around 11:32 a.m. 222,000 sweeping the 74 strike calls for this Friday. Stock is currently trading down 5.17% to 67.27.
In 10 minutes time now, US is selling $58 billion of 3-year notes. Prior bids cover of 2.62 with a prior high yield of 4.332%. So just taking a quick look at the preview ahead of this 3-year notes auction. So this week's front-loaded Treasury auctions are also competing with a heavy corporate issuance calendar, which may deter some auction participation, along with Friday's jobs report.
Friday's jobs report. There must have been an error in what they said, because that was last week. Unless that was commentary about how the jobs report would dissuade bidding this week, but I don't think that it necessarily would. Anyhow, the auction coming right up. We're going to be watching.
So again, taking a look at the auction ahead of this 3-year notes preview. Ignore those past comments, they were for the auction last time. However, while Chairs Powell Senate Banking Committee testimony could add some volatility to front-end yields over the US morning session, JP Morgan strategists see the auction being digested smoothly given attractive valuations. Latest CFTC positioning data shows speculators were net short 1.9 million 5-year note futures, and a record amount and a possible source of covering demand. Dealer inventories in the 2 to 3 year sector were net long $26.9 billion in the week ended January 29th, highest on record and well above the $14 billion average net long over the past 12 months.
I'm going to take a Reg RIG Romeo India Golf. Circulations on CNBC and new positive mentions on the stock. Jim Labenthal. Sure seeing continued activity, new highs. RIG.
So in 5 minutes time now at the top of the hour, we do get the 3-year note auction. So the US selling $58 billion of 3-year notes with a prior bids cover of 2.62 and a prior high yield of 4.332%.
I've been having dreams, jumping on a trampoline, flipping in the air. I never land, just float there. As I'm looking up, suddenly the sky erupts. Flames alert the trees, spread to fallen leaves. Now they're right upon me. Wait if I'm on fire. How am I so deep in love? When I dream of dying, I never feel so loved. I've been having tripping, I fall in. I've been having dreams. I've been having dreams. Splashing in the summer stream. Tripping, I fall in. I wanted it to happen. My body turns to ice. Crushing weight of paradise. Solid block of gold.
So EU Commission statement after the bilateral with von der Leyen and US VP Vance, says von der Leyen and Vance reaffirmed strength of EU and US relationship and its vital role in today's geopolitical landscape. Von der Leyen also emphasized to Vance the EU's commitment to a just and lasting peace for Ukraine. So von der Leyen reaffirmed to Vance EU's commitment to fair trade relationship, while both parties expressed their intention to prioritize economic areas of mutual interest, including energy. So 1 minute to go now till we get the Treasury when issued yield for this 3-year note auction. Auction results to follow a couple minutes typically after. Treasury when issued 3-year yield 4.313% before the $58 billion auction. So again, when issued 3-year yield 4.313%. Bids cover 2 spot 79, 2 spot 79, high yield 4 spot 3%, 4 spot 3%. So the US selling $58 billion of 3-year notes, awarding 41 spot 59% of bids at high. So primary dealers taking 10 spot 18%, direct taking 15 spot 82%, and indirect taking 74%. So again, Treasury when issued yield came out at around 4 spot 313%. The high yield for the 3-year note auction came out at 4 spot 3%. So according to a letter, Iran warns that any act of aggression will have severe consequences for which the US will bear full responsibility. So according to Politico, Vice President J.D. Vance will meet Friday with Ukraine's Zelensky.
Ticker Rivian, RIVN. Note Rivian is tweeting and teasing an event for February 19th for Rivian. A Mirage takes shape February 19th. Watching shares of Rivian. Ticker Nikola, NKLA. Shares are seeing continued heavy activity, new highs for Nikola, November Lima Alpha.
US Treasury 3-year yield pairs gains after solid 3-year note auction, last up 2.3 basis points at 4.315%.
Shortly expecting the results of the Federal Reverse repo operation. $36 counterparties take $76.446 billion at the Fed Reverse repo operation.
Absorption CLH59 expires at 73.32.
It's forever, nothing feels better. We're right above heaven. Must be more than medical love. It's forever, nothing feels better. We're right above heaven. Must be more than medical love. It's forever, nothing feels better. We're right above heaven. Must be more than medical love. It's forever, nothing feels better. We're right above do with your kiss on my neck. I don't know what feels true, but this feels right, so stay and say. So stay and say. All the things that we wished they never came true. All the promises made were broken by you. All the choices you made, would you make them again? All the lies that you told, did you believe in them? All the things that we wished they never came true. All the promises made were broken by you.
Ticker CNSP, Charlie November, Sandy Papa, shares are seeing a spike in activity, new highs, CNSP.
Our posturings, our imagined self-importance, the delusion that we have some privileged position in the universe, are challenged by this point of pale light. Our planet is a lonely speck in the great enveloping cosmic dark. In our obscurity, in all this vastness, there is no hint elsewhere to save us from ourselves.
These presents don't really come for free. Your paycheck don't mean that much to me. Just take my hand and hold me tight. You'll never buy my love. You buy me this and you buy me that. So lean over, you lean over. You got me wrong and that's a fact. Something that you got to know this. Will you see that way I'm wrong?
Macro note. I come from social media circulations and macro note. President Zelensky has stated he's open to territorial swap between Kursk and Russian-controlled land.
rushing, hit a wall. Right now, I need a miracle. Hurry up now, I need a miracle. Stranded, reaching out. I call your name, but you're not around. I say your name, but you're not around. I need ya, I need ya, I need you right now. Yeah, I need you right now. So don't let me down. I think I'm losing my mind now. It's in my head, darling. I hope that you'll be here when I need you the most. So don't let me down. Don't let me down. Yeah, don't let me down. Running out of time. I really thought you were on my side, but now there's nobody by my side. I need ya, I need ya, I need you right now. Yeah, I need you right now. So don't let me down. I think I'm losing my mind now. It's in my head, darling. I hope that you'll be here when I need you the most. So don't let me down. Don't let me down. Yeah, don't let me down.
There was a time I used to look into my father's eyes. In a happy home, I was a king, I had a golden throne. Those days are gone, now the memories on the wall. I hear the songs from the places where I was born. Upon a hill across the blue lake, that's where I had my first heartbreak. I still remember how it all changed. My father said, don't you worry, child. See, heaven's got a plan for you. Don't you worry now. There was a time I met a girl of a different kind. We ruled the world. I thought I'd never lose her out of sight. We were so young. I think of her now and then. I still hear the songs reminding me of a friend.
According to Semaphore, Trump is expected to sign an order today on reducing staff. French central bank sees first quarter growth of 0.1 to 0.2% after minus 0.1% in the fourth quarter.
The North Dakota cold snap shuts 60 to 90,000 barrels a day of oil output.
Absorption NQH5CME1 sellers at 21,800.5. Exhaustion in NQH5CME1 by sellers at 21,795.5.
A White House official confirming earlier reports says Trump plans to sign an executive order today directing agency heads to coordinate with DOGE to shrink the federal workforce and limit hiring to essential positions.
I see you out, slay you alive. One more word and you won't survive. And I'm not scared of your stolen power. See right through you anyhow. I won't soothe your pain.
Hamas reiterates its commitment to the Gaza ceasefire deal and holds Israel accountable for the complications and delays.
Trying to have some fun, and you're the only one I want. We're gonna leave the city. We'll drive and drive for miles. No time to think about it. Let's run away, let's run. The city has my heart, but now we're miles apart. We'll make a brand new start. Let's find a new beginning. Lights out, lights out, lights out, lights out.
NYMEX gasoline March futures settle at $2.14 a gallon. NYMEX diesel March futures settle at $2.51 a gallon. NYMEX natural gas March futures settle at $3.51. And NYMEX WTI crude March futures settle at $73.32 a barrel. So according to Ukraine's Zelensky, Ukraine is prepared to offer a territory swap with Russia. So that is according to AFP News. So Ukraine will offer a swap territory with Russia in any potential peace negotiations to end their nearly 3-year war. Zelensky added that he would offer the Moscow territory that Ukraine seized in Russia's Kursk region 6 months ago.
Safety both in your arms. My thoughts begin to bleed. I think I'm thinking too much. Oh, but I like feeling the rush. I'm exactly where I wanna be. Flashes and waves don't try to save me now. And it always hits the same way. Only the sun could ever phase me out. Oh, I'm still dancing in the flames. I'm in a haze, someone come save me now. I know it always is the same way. Only the sun could ever take me down. I'm still dancing in the flames.
Sorry, I ain't got no money. I'm not trying to be funny, but I left it all at home today. You can call me what you wanna. I ain't giving you $1 this time. I ain't gonna run away. You might knock me down, you might knock me down, but I will get back up again. You can call it how you wanna. I ain't giving you $1 this time. I ain't gonna run away. This time I ain't gonna run. Not this time. Not this time.
And Brent crude futures settle at $77 a barrel. That's up $1.13 or 1.49%.
Sorry, I ain't got no money. I'm not trying to be funny, but I left it all at home today. You can call me what you wanna. I ain't giving you $1.
Absorption ESH 5 CME sellers at 6091.
This time I ain't gonna run. Not should arrive. We lie so vacant in the dark. Take me now so I can wake up and drift away.
Absorption ESH 5 CME sellers at 60.98.
So Euro jumps to a session high of 1.0379 against the US dollar. So just noting that there has been some downside in the US dollar. No news catalyst as far as we're aware.
Can I have your number? Looks like blue must be your color. Love the way you wear that dress, even though your hair's a mess. She said it's Isabel Marant, and I got everything you want. Only questions, can you hang? Will you come and entertain? I will, I will, I will. Never forget the thrill. We know, we know, we know what we came for. Chicago, graduated in the Bay, had her birthday in LA, said I had to go to Paris, private jets on her parents, asked me if I wanna roll, I said if you take me home, I will, I will, I will, never forget the thrill, we know, we know, we know, what we came for, what we came for. Lift me from the
Seeing an interesting push here up to gamma 6, that 609650 level on ES. So we pushed through the hot call. We're seeing flows building in that warm call now up to 70K. You can see just overall the call flow is once again outpacing puts quite significantly on the options chain for S&P 500. So it does suggest we could actually stretch all the way up to where that warm call is now, particularly if it becomes the most active option on the chain. And we like to get that juiciness in usually during the last half hour of trading, so I wouldn't be too surprised if that's where more volatility potentially resolving to the upside comes in. But, you know, sans any Trump headliners.
lift me from the ground. us have to friend, 'cause I know the looks like a door, and we will never be alone again, 'cause it doesn't never every day. Gonna count on you being a friend, gonna give it up again away. Now I thought about what I wanna say, but I never really know where to go. So I gave myself to a friend, 'cause I know the looks like a door. She just said, is it true? Is it
Absorption NQH5 CME1 buyers at 21,831.5.
I just wanna see the light. 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 Even if it makes me blind, I just wanna see the light. Breathe in, leave it all behind. I just wanna see the light. Even if it makes me blind, I just wanna see the light. Breathe in, leave it all behind. I just wanna see the light. I just wanna see the light. Even if it makes me blind, I just wanna see the light. Breathe in, leave it all behind. I just wanna see the light. Even if it makes me blind, I just wanna see the light. Breathe in, leave it all behind. I just wanna see the light. I just wanna see the light.
Bear in mind that U.S. Energy Secretary Wright is currently speaking. That's 3:30 p.m. Eastern Time. We expect comments from Fed's Bowman. So Fed's Bowman speaks on bank regulation to the 2025 Iowa Bankers Association Bank Management and Policy Conference. Text is expected, but no Q&A. We also expect comments from Fed's Williams, who gives the keynote remarks, followed by a moderated Q&A at an event hosted by the Pace University's Economics Society. Text and Q&A is expected. US energy chief says the US is focused on reducing the cost to produce oil. At 3:30 p.m. Eastern Time, we expect comments from Feds Bowman. So Feds Bowman speaks on bank regulation to the 2025 Iowa Bankers Association Bank Management and Policy Conference. Text is expected, but no Q&A. We also expect comments from Feds Williams, who gives keynote remarks, followed by moderated Q&A.
One more time. One more time. One more time. We're gonna celebrate. Oh yeah, alright. Don't stop the dancing. One more time. We're gonna celebrate. Oh yeah, alright. Don't stop the dancing. One more time. We're gonna celebrate. Oh yeah, alright. Don't stop the dancing. One more time. We're gonna celebrate. Oh yeah. One more time. One more time. We're gonna celebrate. Oh yeah, alright. Don't stop the dancing. One more time. We're gonna celebrate. Oh yeah, don't stop the dancing. One more time. You know I'm just feeling celebration tonight. Celebrate. Don't wait too late. No, we don't stop. You can't stop. We're gonna celebrate. One more time. One more time. One more time. A celebration. You know we're gonna do it right tonight. Hey, just feeling. Music's got me feeling the need. Yeah. Come on. All right. We're gonna celebrate one more time. Celebrate and dance so free. Music's got me feeling so free. Celebrate and dance so free.
So Feds Williams says inflation is to hang around 2.5% this year and 2% in the coming years. Economic outlook is highly uncertain due in part to the government policies. Modestly restrictive policy should return inflation to 2%. Monetary policy is well positioned to achieve the Fed goals. The Fed has made significant progress lowering inflation. The labor market is in good place, but not an inflation driver. US unemployment rate should stay between 4 to 4.25%, and the US to grow by around 2% this year and next. The US economy is in a good place, inflation expectations are well anchored, and wage gains are consistent with productivity and inflation outlook. The US's right says Doge has read-only access to the Energy Department's data.
It's true, I crave you. I walked into the room dripping in gold.
Trump says I had a great discussion about Gaza. So Trump currently speaking at the White House.
It's true, I crave you. Let's just stop and think before I lose I walked into the room dripping in gold. I walked into the room dripping in gold. A wave of heads being tied, so I can told. My heart broke when I saw you kept your gaze controlled. Whacking up so quick and you want me like the other boys do. They stare at me while I crave you.
And Trump says maybe we have to look at the judges and objects to judges blocking efforts to cut government waste. And Musk says basic controls are needed at the Treasury.
So final 14 minutes of the trading day are ahead of us here. We just slipped below the big green line and the 60-90-75 pivot, as well as Gamma 7, which converges with the warm call level. So sellers gaining a little bit of an upper hand in these last 14 minutes, seeing some support at Gamma 8 around 60-87, but overall, just seeing a little bit more selling, a little bit more conviction behind that selling as we approach the close. Let's just switch our views here for a moment.
mind. I just wanna see the light. Breathe in, leave it all behind. I just wanna see the light. 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 Even if it makes me blind, I just wanna see the light. Breathe in, leave it all behind. I just wanna see the light.
Williams says the Fed is not quite at its goals, but the economy is in a good place.
He's not wrong overall. In the aggregates, the economy does appear to be in a largely good place. I told Boog maybe we could get down to 60.79. That's the lowest that we could see into this close. We only got about 11 minutes left. We are seeing some support around 60.87 on this recent draw, but sellers are getting a little more aggressive here into the close. Let's see what we get.
One minute till we get the market on close imbalance.
I was on fire for you. Where did you go? I could have died for you. How could you not know? I was alive with you. You brought in the cold. Was I being
And we're getting just a little bit of a
Market
pop
on
off
close
there.
imbalance. The S&P 500 a buy side of 150 million. Nasdaq 100 a buy side of 516 million. Dow 30 a sell side of 1.3 million. And the Mag 7 a buy side of 255 million.
A little pop off at 60.87 gamma 8 level. Still below BGL, still below that key 60.90.75 pivot as well. And some of the flow into the close got some sweeps coming into Tesla, targeting a 330 strike, 300 to 3,000 in premium paid for those expiring this Friday. They also have some XLV healthcare puts coming through in a trade targeting the 145 strike, 205,000 in premium paid there. Pretty aggressive, 11-to-1 volume to OI ratio.
Just dropped. Thinking about you. Just stops. When I'm without you. Just dropped. Thinking about you. Just stops.
And tomorrow is another fun-filled day. We have CPI. We have another day of a Fed Powell testimony. We've got 10-year note auction and a litany of other Fed speakers coming through as well. So expect that we'll probably have some shaky, choppy trading, lower liquidity, a little bit more room to move about. But overall, I don't expect any major fireworks unless we have some strong deviations away from expectations. Particularly in CPI, I would be looking at 0.4% or higher on core to bring the market down, 0.2% or lower
Trump
on core month
and
over
Musk
month
say
to
there
get
are
a
a
good
lot of
bid.
kickbacks in the government.
Casio, playing on my heart just like a Casio, breaking it apart so you can let it go. Oh, wait another year, that's not original. I'm cynical, alright, let's go now. When all your dreams are gone, and you're still holding on, you waited for too long.
And Trump says there could be close to $1 trillion of waste that we're going to find.
I just want the keys back to my vehicle. They're just gonna tell you that I wasn't real. And I just wanna tell you this is how I feel. I know you feel it. When all your dreams are gone, and you're still holding on, you waited for too long. I know, you know, the song. Casio, playing on my heart just like a Casio, breaking it apart so you can let it go. We're another year, that's not original.
So a bit pinned into the close here overall. Still stuck below that 6090.75 pivot, just above 6086 on Gamma 8. There is a fair amount of volume coming in, but this is not a very busy close overall. Typically, you get a lot more transacting happening in that last 10-minute, 15-minute period. In fact, it's usually the most aggressive period of volume during the entire trading day. Not so much today, on a day that's also brought SPY trading volumes to lower levels than we typically see over the holidays. So overall, this is a very lightly traded market. Won't take much to move it quite a bit as well. That's the other side of a lower liquidity environment. And if we look at it from that perspective, we can see the order book depth here is about 39,000. So it's not too light, but it's certainly not where I'd like to see it. I like the order book depth between 50 and 60,000 on ES. You can also see there is some supply overhead. We can see that in the bookmap view. I might give buyers just a little bit of pause, knowing they may not have the supply to make a decisive push above there. So we're sort of getting glued here. Right above that aggressive sell delta from earlier that we were talking about, just right at that point of control now. Got just about 3 minutes left into the close here.
Trump says, I don't know if Doge cuts will need a vote in Congress, though I think I would get the vote.
Yeah, they would. Just so we're clear here. It's kind of a shame that I even have to say that, but yes, most of those would. Most of those authorizations were authorizations by Congress. It's not a monarchy that we live in. The president doesn't have absolute power. A nice little bid here into the close. We just got about 50, it's about 50 seconds left here. Getting bid up back to the warm call. Used to be the hot call level there around 60, 90, 175. It's also Gamma 7 now. So, folks, thanks for tuning in. Be back tomorrow as we have another day of Powell
Absorption
testimony.
NQH5CME1 sellers at 21,785.25. Absorption
And
ESH5CME
note
buyers
option.
at 6,091.75. Exhaustion in NQH5CME1 by buyers at 21,783.25. Absorption ESH5CME sellers at 6,092.75. Exhaustion in NQH5CME1 by buyers at 21,793.5.
So thanks everyone for tuning in. Catch you tomorrow for CPI, Powell, and the 10-year note auctions and everything else. Should be another fun day.